Greetings, traders. It is I, Abdul Shabazz. This is some real change stock options trading journey. Greetings, traders. This is Abdul Shabazz, and this is some real change. Stock options trading journey, and today, this magnificent Monday, is tweaking up my plans just a little bit, and some tweaking is absolutely needed. That's a lower high, clear area of resistance. I gotta bump it up. I have to change these call plans. Changing my call plans right now. $662.5. I still like the $662.5. $662.5. I'll do. I like the $662.5. Right back to $666. That's gonna be a no-brainer. $666. Right back to 666.2, and then see if we get stuff there. If we don't get stuff, we pop above that and possibly say, yeah, I'm gonna leave it like that. All right, put my first alarm. At the 662. 3. Put it at 662.3. Put my put alarm. Right here at the 654. 4 and below. Should pop up there. Shout out to the team. So grateful for you guys checking in. Looking over these plans. Todd Maker's in the building. Quiet Soul is in the building. Hope everybody had an awesome weekend. Todd said good morning. Jared said hello, everybody. And Kosi, good morning, everyone. Grateful for the team back here. Grateful for those of you who've been watching the replay as well. We see you and appreciate you. Thank you so much. Very interesting. Very interesting. But this is what I have so far coming out the gate. If anybody else has any plans, please feel free to share them. Greatly appreciated if you decide to. This is what I'm looking at. Let me start off with my trading view. Looking to see if we can finally get out of this controlled selling algo. Even though we had a big gap up, that really means nothing. It means really just an opportunity to short a lower high. That's how a lot of people are looking at it. An opportunity to short a lower high. Being that we are in a downtrend. If you don't know, I'm here to let you know. This year, the market is in a downtrend. This year, the market is red for the year. All pops are being shortened. It was up until this week. Let's see what happens this week. But that has been the message that the market has been sending. All pops have been shorted. Will that change this week? Only time will tell. Definitely waiting to see how the story unfolds. But that's what I'm looking at. I'm looking at a put. I don't know why I dropped it even more here. I got the put. I dropped it to here, to the 653, then taking it on down to the 648, and then the 645. 656. That's where it's at right now. That's why I originally liked the 656 area, but I moved it down to 653. And it's a short there from the 656 down to the 653. But it's Monday and it's early. So I really moved it down even further, per se, Your Honor. So let me see how I can clean this up. Okay, there it is. I cleaned it up now. That's what I'm looking for if we get into a call. Break below. Alarm is at 654.4. A break below that. Break and retest. Take us down to potentially some new lows for this week. Every week is not the same. Every day is not the same. But our discipline is the same. Our approach to the market is absolutely the same. Yeah. Want to give it just a little bit more time. Market is looking strong this morning. Right now, everything is green. So we can probably expect a little turnaround here. But as always, you know we got to keep the news up. With 47 in office, anything can happen. Literally anything can happen. Sir Night is in the building. That's wild that the market is down overall when so many companies are posting profit, still posting profit. It's almost like the SPY is disconnected from the profit performance. It's like a more reflection of sentiment. Thank you for that, Sir Night. And he's absolutely correct with that. We're just showing that the market is up. Tesla's up. Apple's up. Netflix is up. All of the Magnificent 7 are up. And the VIX is at 24.3. Very interesting. Watching the higher time frames is going to be key today. Watching the higher time frames is going to be key today. Top right is the daily chart. Bottom right next to me is the weekly chart. Bottom middle is the 30-minute chart. And over here to the left, and I'm cleaning up right now, is the 15-minute chart. Again, the larger time frames are going to be more key going today. And he said, I'm not trading today. I'm mentally spent from doing back testing all weekend. And Kosi, I don't blame you. I'm kind of leaning a little bit myself towards allowing this market to settle, possibly looking at an afternoon trade. I don't want to run into anything this morning because the market is saying one thing with his mouth, but his feet is going in a different direction. Big Ben, good morning, my peeps. Good morning, Big Ben. Grateful day is upon us. Especially with that big move this morning in Kosi, that $20 move from 645 to 665 pre-market. Retail traders had nothing to do with that. Institution know something. They know something. They know something. I don't know what they know, but they know something. Touch Friday's high. After we touch Friday's high, we bounce right off of Friday's high. Bulls are rejecting anything lower than that 656. Anything lower than that, they just rejecting it. Jesse Swanson is in the building. Good choice. Everybody is agreeing with you and Kosi. Good day to you all. Good call in Kosi. Good morning, Abdul and team. Yes, sir. I'm with you on that note too, guys. You know, as far as being just a little bit more observatory this morning. I'm not saying I won't take a trade today, but I am saying that I am leaning more towards the afternoon. This huge bullish candle from the 645 to the 665 concerns me. Concerns me. I don't want to consider anything bearish until after the second leg of this move is potentially forced to cover. That'll take place below the 645.4. Have an alarm there. Until then, this is a lot of support to liquidate any early bearish moves to take us to a potential higher high for today. However, let me go ahead and blow this up so we can break down the sentiment of this move. I'm going to break it down on the 2 minute. As you can see, the two parts of this move. First leg went from the 643 up to the 655. Second leg went from the 655 to the 666. That's over a $20 move retail, where retail was not even able to trade options when this move took place. This is a lot of money, a lot of strength. This is big business, big banks, big everything. So in order for me to even think about a put, I need to see the first half, the second half of this start to cover. The second half will feel pressure before this first bottom half will. So once we get below that 645, 640, 654.4, then I'm interested in a put. You guys know I very rarely use Fibonacci's, but I do use them. And when I do, I like to use just simply the 51% retracement and the 61% retracement. Once a move has gone covered 50% of his, once a move has retraced 50%, well, that's where pressure is going to be decided. Are we going to hold it or are we going to let it go? Once it has fallen 61%, then no doubt about it, everybody's running towards the gate. 50% retracement on this move takes place below 654, and it's just that simple math that I'm using to decide to take a put below the 654. 50% retracement from this morning moves take place at 654.8. I'm looking to get in at 654.3. Okay, that will be the only safe put. Anything above that, you can get trapped. You can get used as liquidity. So there's absolutely no puts should be taken prior to 654.4 and below. Now, what could be the exception? The exception could be if we come back up here to 666 and fail with a very strong reversal signal as we saw in pre-market. Pre-market, we got up here and did a double top. After we did a double top, we then put in a lower high. After that lower high, we put in a lower low. Okay, now since then we've slowly been grinding back up, but we have failed to reach the previous lower high at 663.9. Okay, we failed to reach it there at 663.9. If we can muster our way back up to 662.3, turn this resistance, break and retest, turn this resistance into support, then there is a reason to potentially stand on a call to retest that 666. Take that easy money from the 662.4 back to the 666, knowing that there's going to be a retest there. If we can turn this 662.3 area of resistance into support. That is also the reason that I've chosen that area for a potential call, a 662.5. I got an alarm at 662.3,
looking for a break and retest, turn this into support. We can stand on that to go back and retest the pre-market high of the 666 area. So if that easy money takes place, then I'll take a call at the 662.5. Only gonna take it to 666. I'm not gonna say only, because that's a $4 profit move. But as I've stated, the reason I'm not gonna take a call until that area is because of this morning action. The double top, the lower high, the lower low, the fail to reach back to the 662.3, even now once market has opened. Nice climb, right into a shooting star. Beautiful bearish potential reversal signal, even though a red one would have been stronger. But it's the first 5 minutes, very volatile. The first 15 minutes can absolutely trick you, as we now have a new 15-minute candle in the ORB. So let's take a look at that. Just wanted to blow that up real quick so you can see what I'm thinking based on this pre-market action. That means something. These huge elephant size big bull candles mean something. I don't know what they mean, but I know they mean something. I don't know what they mean now. They mean something. Look at that 15-minute ORB. Look at that. What do you got? Nothing. Nothing, not a ting. A huge doji followed by right now another doji. Not a ting. Does anyone who holds spot overnight have any tips? I'm going to another shift soon once another mechanic is hired. And Kosi holding this overnight right now. That's a little form of gambling. We don't have any clear decision. It's Monday. We don't know who's in control of the week. We don't even know who's in control of the day. We do know who's in control of pre-market with this lovely gap up, but that took place without retail. So we're waiting to see what retail is deciding to do. And right now the volume is dying off on retail. So you'd be better off with a straddle move for real, than trying to decide a direction, because it's just not enough information just yet. Now, if you want to go with overall views, overall the market is in a downtrend. Overall, we're red for the year. Overall, we've been red for the past couple weeks. But that's playing a much larger than what's going on here now. Let me blow this volume up now here so we can see. You can see the falling off, and even so much so in Kosi going off of the larger time frames. The 15 minute, as I said, we're off the 2 minute, we're off the 5. Look at the 15 minute. No decision here. Yeah, you had the gap up, but we're suspended. Okay. Also, you can see why I like above that 662 as we go back into Thursday's action. If we can get above that 662, that will look like continuation towards the upside. Now I can see you getting an overnight call. Okay? Because, now again, this is the 15-minute chart. We're backing up. We're looking at a much bigger picture. You can clearly see now why I have my call above the 662. I didn't even see it until I backed this up and looked at it. But it perfectly makes sense. Absolutely. We get above the 662.3. We now can look at some continuation. The last time we were in this area, we had a severe drop, and we dropped all the way from the 662, and we kept dropping all the way down to the 641. Okay? Now, pre-market is giving us some of that back with a nice $20 move. Okay, from the 645 all the way to the 665. But then I showed you what happened pre-market. So again, even still right now, this particular area is an area of resistance. So I really need to change the color for accuracy so we don't mislead anyone. Let me do that real quick. Thank you for your patience. All right. That's an area of resistance for now. You have to get over that, break and retest to turn this into an area of support. And then we can see, something for the bulls to stand on. Right now we got clear rejection above the 659.6. The bears have a line there, not allowing anything over that right now. So just simply looking at this action, sir, there's nothing. And we've gone all the way back to last Wednesday, last Thursday's action. Saw like a break over that. Okay. See if that's sustainable. Good move here at the end of the day with a nice red hammer. Led right into today's gap up. The market is green in Cosi. The market is green. Let me show you my trading view chart. And I did see that control buying algo potentially as well, because the market is green. But in order to challenge this huge bearish move in Cosi, we really got to get up in them 662 areas and higher for you to walk away from a call. Absolutely. Before you walk away from it, you got to be planted securely above 662. If not, it could come crashing back down on you. As the market is showing us, we went up there, put in our high here at the 697. Then we did the same thing. We put in a double top, a lower high, and then she came on down. And did she come down? She came on down. And has been coming down consistently week after week after week after week. At some point, the bulls will buy in, and maybe this might be an indicator with all that pre-market action that they know something we don't. The market's green, positive news, but we need to see more than continuation. We need to see more than confirmation. We need to see continuation around here. So keep that in mind. Bulls making a nice move. Is it sustainable? We will see. We will see. There is a nice little buying algo. Let's go ahead and acknowledge it. We're going to acknowledge it, the nice little buying algo. Okay. Alrighty. And Coach said I'll be back once the training is completed. Awesome. Shout out to your teammate. Give a shout out to Nkosi, who is working on his dreams while still working for the Bills. Looking forward to that day where I can remember when he was working and we can say, you know what, he's finally been able to retire himself from that job. May it happen for you. I mean, I was looking at increasing volumes at the end of the market on the 5-minute chart. Back testing was inconclusive. I need to go back and pre-test pre-war markets. Aha! And test pre-war market. Yeah, because this is... look, we gotta talk about it, yo, because it is what it is. We're at war. We're at war. And 47 gave them 48 hours to stop. And they responded with even more barrage of attacks. So I don't know what could possibly happen today. So we better have the news up. For real, for real. You got my thoughts. You got my plans. You know I'm completely transparent. I have my alarms set in place. I'm able to show you this controlled buying algo we're currently in. But please look to the larger time frames today. Don't let them fool y'all. Stick with the larger time frames today. Possibly wait till this afternoon. Get his markets time. Realize that you and I do not have the advantage right now. We don't have edge. There's no edge presented right now. So we don't want to be taken advantage of. Let's let this market figure out what it wants to do. And we will come back and pick it apart. There's no doubt about that. But safely. Volatility is going to increase as investment firms ramp up their use of AI in the markets, as well as retail use of AI in the markets. Sir Knight is saying. Yes, sir. That's a good thing to the upside, though. There's going to be a point where the big boys start buying back into the market, and it may have already taken place. So Knight is saying that volatility is definitely going to increase as investment firms ramp up their use of AI. That's right. Computer, high speed, algorithmic trading. Now with AI. Oh boy. Guess they're going to try to figure us out on one thing that we can hold accountable for. If they didn't take account for our patience. They didn't take that into account. How patient we can be. That is our superpower. We don't have to trade. We can see what the market is doing, see if our edge is present, and if not, sit back, relax. Sit back and relax. And that's why we look at multiple charts. Because if you just look at the 30-minute without pre-market, it could possibly mislead you. As you see clear overhead resistance at the 662 and below. So there's overhead pressure from the bears. Looking kind of enticing. Well, let's go to another 15-minute candle here in 45 seconds and see what the next candle does. Very interesting.
what's left and let it.
So you said there's many points of agreement with Iran right now.
Many.
What can you give us a
Many, like 15 points. 15
Here we go.
Iran has said yes.
Well, they're not going to have a nuclear weapon. That's number one. That's number 1, 2, and 3. They will never have a nuclear
They
weapon.
said yes to that.
They've agreed to that.
Will we see arrests or illegal migrant arrests at airports, sir?
Arrests.
Will we see ICE arresting illegal migrants at
Yeah,
airports?
yeah. That's why the Democrats are going crazy, because they've allowed, by what they did, and hold up, we put ICE, who are a very high level. I mean, they really are a high level group of people. And they love it because they're able to now arrest illegals as they come into the country. That's very fertile territory. But that's not why they're there. They're really there to help.
Are we talking to Iran directly?
To no enrichment whatsoever, even for medical purposes, civilian purposes?
They have. Thank you.
And what about the Strait
Thank
of
you.
Hormuz? Who's going to be in control of
That'll
that?
be opened very soon if this works.
How soon? And who's in
Immediately.
control of it? Will
Immediately.
Iran still be able to control the flow of oil?
Be jointly controlled.
By who?
Maybe me. Maybe me.
You want the United States to be in
Me
control?
and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and there'll also be a form of a very serious form of a regime change. Now, in all fairness, everybody's been killed from the regime. They're really starting off. There's automatically a regime change. But we're dealing with some people that I find to be very reasonable, very solid. The people within know who they are. They're very respected. And maybe one of them will be exactly what we're looking for. Look at Venezuela, how well that's working out. We are doing so well in Venezuela with oil and with the relationship between the president-elect and us. And maybe we find somebody like that in Iran.
Are you considering any more options to lower the price of oil while these talks?
The price of oil will drop like a rock as soon as a deal is done. I guess it already is today. No, we have a very serious chance of making a deal. That doesn't guarantee anything. I'm not guaranteeing anything. I'm not going to come out here in a week or 2 weeks and have you all say, oh, you said. I didn't say anything. All I'm saying is we are in the throes of a real possibility of making a deal. And I think if I were a betting man, I'd bet for it. But again, I'm not guaranteeing anything. They want to make a deal very badly. Thank you.
What changes would you like to see in DHS under Mark Wayne Mullen?
Well, he's going to be fantastic. He'll make his own change. He's already given me a list of people he wants to bring. He's a fantastic guy. I think he's just the right guy. You all know him. He's a very open, smart guy, very successful actually in business, which people don't know. And he's a friend of mine. I think Mark Wayne is going to be fantastic. Thank you.
Are these direct talks for Iran?
On the plane crash that happened
Terrible. They made a mistake. It's a dangerous business. That's terrible. Thank you.
All right, that was President Trump. Some wide-ranging comments on two key areas. One, of course, the war in Iran and talks to end it. The other, the presence of ICE agents in airports helping depleted TSA ranks. For the purposes of our audience and certainly what we focus on, let's talk about Iran, because we got a lot of potentially important bits of information from the president. It would appear that, according to the president, talks between at least some leadership faction in Iran, and he made it clear, it's like given how many ranks in the leadership have died, it's not completely clear the level of communication or exactly who is in charge. He did say, however, that those talks between both Steve Witkoff and Jared Kushner perhaps began yesterday and continuing. They are going well. He said towards the end of his comments there's a real possibility, though not a guarantee, that they will reach a deal. He talked about 15 points of agreement and said numbers 1, 2, and 3 are all about them giving up any hopes of obtaining a nuclear weapon. He talked as well about the U.S. taking control of the enriched uranium that Iran already has, and coming back to it time and again said, if this happens, and I think it's going to, it will bring peace for Israel and for the region. He said as well that the threat from the U.S. of knocking out some of the key generation facilities of electricity in the country. And again, the president said that Iran called the U.S. to initiate these talks. He said, I didn't call them. And he also indicated they have agreed to the provision of not having nuclear weapons. Sarah, well, a lot there, and certainly much of it seemingly positive for those who would think that an end to this conflict is near.
I tell you what, if you know like I know, you better wait and see what Iran says first. Before you start jumping in this trade, you better wait. You better wait, because they respond real quick. That's one thing about whoever is a spokesperson over there. Whenever Trump says something, if they don't agree with it, they respond real quick. So yeah, I'm gonna wait this morning, man. I'm not gonna put my money in this right here. Not just yet. You know what I'm saying? You know what I mean? So I'm gonna hold off. I'm gonna hold off. So trade at your own comfort level. You know, I'm gonna just get my popcorn ready. That's all I can do, man. I'm gonna get my popcorn. But I'm not gonna be the liquidity. I tell you that. We're not gonna be the liquidity. I tell you that. These are not normal times. The market is not responding normally. We just have to be patient. Sir Night said, nasty work. Big Ben said, scalp fast.
Sarah, is still unknown, except we did get a lot of specifics around no nuclear weapons.
Todd said, just lies. Just lies.
I think the market is speaking. The WTI crude is down 10% right now. So the market is buying the Trump optimism and the sort of let's pause for negotiations and discussions, trade. And as you know, President Trump said, we'll see as soon as it opens up, which could be immediately if these talks succeed, you'll see oil prices drop like a stone. And we're already seeing that in anticipation of something hopefully.
Well, let me know, because I'm ready to go to the gas station right now.
Stocks are higher. I mean, this has been the reversal of the trade. We're going to be all over this market reaction for you to these Iran developments. Coming up, we're going to hear from Energy Secretary Chris Wright. This is a first on CNBC interview as oil plummets right now. Plus, global markets expert Ruchir Sharma is with us, along with tech investor Dan Niles, to break down the action in equities and how to invest in this volatile, headline-driven market. But, David, it's worth looking at just what's happened so far and the interesting new market dynamic that has developed this year as a result of some of the geopolitical tensions. Remember, everyone, all the doomsayers were saying there's been this sell America trade on since the tariffs. Can't trust the American assets, and people were pointing to the fact that U.S. bonds were down and the dollar was down and stocks were down. Well, Torsten Slok at Apollo took a crack at this and showed how many days basically this year that stocks, the dollar, and bonds sold off simultaneously, and it's just not happening. 9 days this year that happened. So that whole sell America trade, not a thing right now. During times of global turmoil, actually the dollar, the U.S. dollar, has been the winner. That has reasserted. I'm
about to leave the house right now. I got about 4 jugs on me, man. I've been battling between a quarter tank
other countries
all week long,
economically more than we do. Because
we
don't import as much oil, say, as China and as Europe, certainly, as Korea. And so the U.S. has been sort of a relative safe haven trade. Even though it's felt painful for some of the U.S. equity investors, it's done better than the rest of the world so far. It's a complete reversal of the outperformance of the world versus the U.S. And I'll just end with the 10-year Treasury, because we eyes on the 10-year. I do wonder, David, and I brought this up a few times, when the market is just really taking this as an inflation risk. You know, high oil, inflation, but not considering the second order effects of demand destruction, you know, what happens with growth, who's going to be the next Fed chair. I mean, some of the other sort of broader risks, employment that basically has stopped growing, job creation, all of that. So I wonder, you know, it's reversing today, but these elevated yields have almost been myopically focused on the inflation story and oil.
Which got some good news, at least today.
Good news if we hope that these talks continue.
Yeah.
And the negotiations lead to an end to the war and to the, I think for the oil market, more importantly, the opening of the Strait of Hormuz.
Which, again, the president was asked about towards the very end of his comments.
Jointly controlled would be something.
I don't know what that means, and it's not clear exactly what it means.
Whether that's
when he goes on to say by me and the Ayatollah.
Market doesn't know what to do right now. Volume has dropped off. The market is at a standstill right now. Retail has no idea what to do right now. Neither do I. So I'm off on the sideline, team. I'm off on the sidelines.
Blocking it?
Yes. Let's get more on this market rally and bring in Ruchir Sharma, chairman of Rockefeller International, CIO of Breakout Capital. Ruchir, I mean, just this morning, a lot to talk about. What's your take in terms of what all this means?
The piece that I'd written this morning for the FT was the fact that America keeps bailing out Trump, and which really means is that what Trump gets away with here is America's pre-existing strengths, and something.
So 99 said we got to figure out what's happening with the Strait of Hormuz. The Strait of Hormuz is absolutely the key to everything here.
The rest of the world is so much more dependent on energy. This crisis has really hurt the rest of the world a lot more, and it's quite telling that if you look at countries in Asia, we're seeing such a big impact. In countries like India, there are gas shortages. There are Thailand, Philippines. These other countries are shortening their work weeks, school closures. So it's been quite devastating for the rest of the world. So the logical conclusion is that if this crisis ends, as President Trump seemed to suggest this morning, it really means that the rest of the world also gets to benefit more because they've been ravaged a lot more by this crisis.
Yeah, that's an important point. Europe in particular, where energy prices have been moved up far more sharply than they have here. What do you see as the impact over there and on the equity markets over there as well?
No, as I said that, like the trend of those international markets outperforming was reversed over the past month. But if this crisis ends, then that trend should logically resume. But I think the bigger question that we have to ask is the fact that that is the American market just going to go back then to its rallying ways? Because as we had discussed even a couple of weeks ago, I think there are other issues that the market is dealing with, whether it's got to do with the excesses of private credit, the AI mania which is going on there. So I think that, yes, we're very intensely focused on this crisis. It matters a lot for international markets even more that if this crisis ends, I think the international markets snap back even more quickly. But I think that the bigger problems will remain, and that I think is getting lost a bit in this entire focus just now on the crisis.
Okay, we can talk about that, but just first on the whole Iran trade, do you think the bond markets around the world are getting too I don't know, expecting of rate hikes in places like Europe? If we do see some sort of resolution to this, wouldn't that change the prospect for? I mean, like on Friday, they were pricing in 3 hikes from the ECB.
Yeah, no, I think that's correct that, some of that may be excessive. But Sarah, I think that the point which we haven't discussed so far is just the overhang of the deficits, because once again, this war is going to put more pressure on increasing defense spending everywhere at a time when public debt levels across the world are already very high. So I think that that's the other issue, which is that there's not been much discussion about that. But even with the tariff rates in the US coming down somewhat, and the fact that defense spending is going to increase around the world regardless of if and when this conflict ends, I think the pressure is going to remain a lot on long-term interest rates, because the public debt, because you have a geopolitical crisis, more pressure to spend, and you have already very elevated debt and deficit levels. So I think that's the point which the bond market is getting concerned about, and I think that remains with us for the remainder of the year.
Gold's been funky lately. It's actually, I would expect it to have rallied because it's been rallying hand in hand with stocks, but it's actually down again today. Hasn't been a safe haven. So what's the gold trade all about? It's also not a protection from inflation if inflation expectations are rising on oil prices.
Yeah, once again, something I'd written about like a month ago, which is the fact that gold had entered this storybook stage, which is the fact that gold was totally disconnected from any fundamentals. The price of gold is supposed to rally when real interest rates are going down, or when central banks, of course, were purchasing reserves around the world. They were diversifying away from the US dollar. But now 2 things are going to happen. One, the fact of the matter is that this very excessive speculation which was going on in gold has been crushed. And the second, probably most subtle point is this, that a lot of central banks, especially in the emerging world, have been forced to intervene to defend their currencies in this crisis. Now, the logical conclusion there is that they possibly need to sell some of their gold holdings to finance that currency support operations. So I think that is a important point that's not been discussed so far, which is that with the dollar once again rising a bit and the currencies of some of these emerging markets being under some pressure, both the reserve accumulation slows down and also some central banks, in fact, are forced to intervene to try and calm down the outflows that they are seeing.
Bashir, thank you.
Great, thanks, Sid.
Here's our roadmap for you for the rest of the hour. Coming up, can't miss interview with the Energy Secretary, Chris Wright, as oil pulls back sharply right now.
Plus, Elliott Management making a big bet on AI, or particularly on chip design, with a new multi-billion-dollar stake. We'll have details on that investment.
And when we come back, investor Dan Niles takes a look with us at how he's allocating money in this volatile market. Squawk on the Street. We'll be right back after a quick break. Stocks are climbing sharply here after President Trump said the U.S. and Iran held productive talks regarding the war. Let's bring in Niles Investment Management founder and portfolio manager Dan Niles. I mean, what do you do on a day like today? We're coming in, it looked like it was going to be ugly and an escalation. And then, President Trump says there are some positive steps here when it comes to negotiating a potentially end of the war. What's a portfolio manager to do?
Well, I mean, I think you have to look at it on what are your risk-adjusted returns looking like. So I've been negative on how this was going to play out because I said, it takes one person to start a war, it takes two to end it. And then on Friday, as you probably saw, I put some thoughts out that, look, the market overall is oversold in the sense that it's not stocks that got me really interested. You look at bonds, and since the end of February, you look at the 2-year, it had moved up 50 basis points over that. And you were actually pricing in rate hikes, not cuts for the rest of the year. And then in addition to that, gold was getting absolutely killed. And so late February, it was overbought. On Friday, it was oversold. And so that's why I said it was a good time to consider putting some cash to work. And so if you look at today, now you've got two people that seem like they want to end this. And the thing I kind of focused on is there's one thing President Trump's focused on. He's got midterms coming in November. He can't have this go on for too long. And it's not how high oil prices go, it's how long they stay there. And so if oil spikes, then it comes right back down. You're going to be just fine with the economy, and that's what you're seeing right now. And so I think the names that you liked, it's a great time to add some more exposure to that. What's really encouraging to me is the asset-heavy names. So I always say you need to get messy. So utilities, materials, energy, staples, and industrials. You look at those names, even though they've had a great year so far, up 9% year to date on Friday's close, they're up another 1.5% today. And so that tells you want to have a mix between asset-heavy names, be well diversified. But I think the AI trade and we can talk about this, but with OpenClaw having come out, that's a good area still. And I think you're hitting another inflection point in token demand.
All right, explain what you mean there. Inflection point, still a good area. What are you saying?
Well, I mean, the key here is if you look at it, the whole AI trade's been about training pretty much up until this point. Then on November 24th, you had this thing called ClaudeBot come out. And that got finalized into what's called OpenClaw at the end of January. And you've seen a massive uptick in agentic AI. And so in basic terms, over the last 2 months, you've seen a 130% increase in token generation. Now, the prior 2 months leading up to this, to the end of January, that was up 20%. So you've gone from 20% growth in tokens to 130 because now people are saying, hey, this agentic AI stuff is actually kind of useful. And with that kind of increase, you're going to see all the stuff underneath it that supports it starting to ramp up again. And so NVIDIA hasn't been performing. Everybody's talking about, oh my God, it's dead. You need to move to something else. Or whatever your favorite, AI infrastructure related names are. But I think what you're going to see is as more and more people start to deploy things that are actually useful, that's eventually going to lead to these AI trades, or at least my favorite ones, starting to work again. And so that's why I think you want to have this barbell of Halo names and AI names,
right,
and be well diversified.
But Dan, when I hear OpenClaw and I hear you talk about agents, then I tend to think about the other trade that's worked so well until lately, which is shorting a lot of the software-related names. Take a look at Microsoft, for example, down 20% this year. Where are you coming out? I mean, they can't all be going out of business, can they? There's got to be some value there, or do you just not touch it?
Well, it's a great question, David. So, one of the things I always say is, look, it's going to take time to sort this out, right? Mark Andreessen wrote that great piece in the Wall Street Journal in 2011 saying software's eating the world. Well, we've only been, 5-6 months into this thing where people are realizing, you know what, AI is going to upend a lot of software. So I think you're going to see a really good rally. You've already seen that in the software ETF IGV. But I think on a longer term basis, you are going to get a lot of software companies getting absolutely wiped out. Because if you don't own the underlying data, which you can't afford to get corrupted, you're the system of record with those. Or you're not protecting that data in that you're a security company, or you're not providing entertainment that people don't want to create. Nobody wants to create a video game, a high-end video game. I think those areas will do well, and so that's where I'm looking in software. But I think you want to stay kind of negative on all the stuff that doesn't fit into those buckets from a longer term basis, and that includes private equity, private credit as well. I wouldn't be short any of them right now because I think this market's going to continue to drive these names up. But I always talk about when the tech bubble broke, the S&P went down 49% over 2.5 years. But you had 7 rallies of 14% each in the S&P 500. And those rallies occurred over 2 months on average. And so all the stuff we hate the most right now is going to rip with the rest of the tape. but it doesn't mean you're still not going to have pressure, because it's going to take a lot of time, given it was 14 years of optimism in software, and some of that is going to have to get reset.
Speaking of ripping with the tape, Dan, if you want to know what's working best today, it's consumer discretionary stocks. It's Norwegian Cruise and Carnival and MGM, the stocks that are sensitive to consumer. When gas prices fall, when oil prices fall, people can spend more and they can go on cruises again. I'm curious why, if you're betting on the recovery trade and the midterms and that Trump wants a resolution, why you like a Staples or healthcare. Those are lagging. I mean, those are more recession-proof ones.
Well, you got to remember, though, a lot of those, like industrials, helps with your energy infrastructure, right? And so what I'm saying is you want a mix of stuff, right? Look at the Magnificent Seven. Even with today's rally, they're down 9% year to date. I don't think you want to be completely concentrated, because you still, to David's point, he brought up software. I think OpenAI still has troubles. I think you're going to get to the end of this year and figure out not everybody's going to win. I think you're going to figure out Google is going to be the one with the hammerlock, and I've talked about that before. They've got the complete stack, and they've got the money to fund all of this. And so I think you need to be very selective when you go through this, and that includes owning some of the names in the heavy asset, low obsolescence category, and that includes Staples. And look at today. Are those sectors falling? No, they're up 1.4% on average. Yeah, and so I think that's my point, Sarah, is that for 3 years it's been buy everything in AI, forget about the rest of the market. Now, well, since really late last year, end of October, it's been, you know what, not everybody's going to win. How's OpenAI going to fund 1.4 trillion in spending when they're doing 20 billion in run rate revenues and they're losing bucket full of money? So that's why I'm saying you have to be selective. You got to figure out who the winners are going to be, right? Not everybody. AOL didn't win in 0102, right? Netscape's not around. So you have to, I think, pick through this stuff, and just throwing money at the Mag 7 is not going to work.
Dan, thank you. Dan Niles. And right now, I mean, most of the stocks are working right now, unless you're in fertilizers or defense. Those are some of the stocks that have been up so much on the war.
Coming up, we're going to have an interview with the Energy Secretary, Chris Wright. It's going to be his first opportunity to react to that plunge in oil prices we're seeing this morning. This is the president signals that perhaps there's a deal getting close with Iran. Plus, we'll have some of our reporting on Elliott Management's new bet on chip design, specifically the software behind it. Synopsys is the name. We'll explain why they own it when we come back.
Welcome back. We're about 30 minutes here into the hour. Here are three movers we're watching. Sports betting names seeing pretty nice gains today on a report that lawmakers are looking to potentially introduce a bipartisan bill banning sports bets on prediction market sites. That's giving a nice boost to Flutter and DraftKings. Travel stocks gaining from cruise lines to airlines as investors bet on lower energy prices ahead. That said, United announcing plans to cut certain routes due to high jet fuel prices, with an assumption of the price of crude staying above $100 a barrel through 2027. We'll talk to United CEO Scott Kirby tomorrow, first on CNBC, about it. And Synopsys shares are gaining on news activist investor Elliott Management has taken a stake in the firm. The latest, I guess, for Elliott, which has been a little bit more active lately. What do you have on this?
Yeah, I mean, multi-billion-dollar stake, so obviously significant, although don't know it to the dollars. It's a pretty simple thesis. Synopsys is one of the key software players in the design of chips. It's either Synopsys or Cadence when you're designing a chip. We all know right now around AI and inference, things we've already discussed on the show this morning, there are an awful lot of chips being designed, not just by NVIDIA, but many of its competitors as well. For the data centers that are going to be running all of these applications in terms of inference for AI. And so the thesis from Elliott, simply put, is you guys add value and you're not raising your prices enough to reflect the value that's there and the fact that your customers need you. And as a line item, even raising prices would not represent that much significant increase in cost overall. When you look at their margin profile versus that of Cadence, something Jim did earlier on the 9 o'clock hour, you'll see that they are, in fact, below what conceivably is available to them. And so they're putting public pressure, what we're doing right here, and private pressure on the company, given the size of their stake, to raise price. Simply put, we'll see, in fact, what the results are of that. But Elliott's certainly a very significant investor now in this name.
Yeah, I've been following them lately on PepsiCo and Lulu, which they've done also sort of running campaigns on recently.
Yeah, they're all over the place.
All over the place. I know. TBD on that Lulu CEO that they want. Meantime, energy prices plunging on Iran de-escalation hopes. Energy Secretary Chris Wright joins CNBC in a first on interview after a quick break.
The price of oil will drop like a rock as soon as a deal is done. I guess it already is today. No, we have a very serious chance of making a deal. That doesn't guarantee anything. I'm not guaranteeing anything. I'm not going to come out here in a week or 2 weeks and have you all say, oh, you said. I didn't say anything. All I'm saying is we are in the throes of a real possibility of making a deal. And I think if I were a betting man, I'd bet for it. But again, I'm not guaranteeing anything. They want to make a deal very badly.
All right, that was the president. He spoke moments ago to reporters, of course, about talks with Iran about ending the war, reaching a ceasefire, a deal in which he did say there's 15 points of agreement, much of it around, of course, the denuclearization, or at least even ending the efforts in that country to obtain a nuclear weapon. Let's bring in Energy Secretary Chris Wright for a first on CNBC interview with our Brian Sullivan. They are both at CERAWeek's Energy Conference in Houston. Brian, take it away.
David and Sarah, thank you very much. We are pleased to be joined by the U.S. Energy Secretary Chris Wright. Secretary Wright, thanks for joining us. The president just made those comments that, get a deal, price of oil is going to drop like a rock. I know you've been in touch with him. You've been in touch with your colleagues around the world, the IEA and more. Are we close to some kind of a deal? And do we even know in Iran who to negotiate with?
Well, if you look at the military campaign in the first 3 weeks, President Trump's leadership, General Kane of the Joint Chiefs of Staff, they've just done a tremendous job. So we are rapidly eliminating Iran's ability to project power to its neighbors. You saw their attempts at longer-range missiles. This conflict is critical to remove the greatest threat to peace in the Middle East, the greatest killer of American soldiers over the last 2 decades, and the campaign's going well. So when the campaign's going well, the other side is thinking, well, maybe there's another way to achieve the same end. And what I love about President Trump, he sets a bold objective, but he's always open for negotiations. If there's a better, simpler way to get the same place we want to get, we're all ears.
But do you think that we can even know who to negotiate with? It's entirely possible we're speaking with people in Iran and other people in Iran who claim they're the real leaders, because we have no idea what's going on, that we're negotiating with different groups about different things, and that's going to impact the ultimate outcome and the price of energy.
There has been quite a bit of turnover in their energy leadership, so I see where you're going there, Brian. And that's one of the things we'll learn in these dialogues. Who is in power? Are they in power? How is it working? But again, always open for dialogues. There seems to be legitimate interest. If we can get to the right place, we'll do it. But we're going to find out who the leaders are and what their authorities are.
So the president said the price of oil will drop like a rock, and it already is. The price of oil is down a lot today, but we're at 89 and change. We're not at 59. We're not at 69. If and when we get a real resolution to this war, whether that's today, tomorrow, or months from now, Mr. Secretary, what are your various scenarios for the price of oil? Because the CEO of United Airlines just said they think we're planning for the possibility of $175 oil.
Yeah, I think that's a business leader being very careful. Fuel costs are massive costs for all the airlines. I think he's being prudent and planning ahead. We certainly don't expect that scenario to unfold. I think that's highly unlikely, but that's what you do when you're leading a business. I think, fortunately, we went into this conflict, thanks to President Trump, with just massive American oil production, good relations with our neighbors overseas. The Saudis, for example, pre-positioned almost 100 million barrels of oil storage out of the Middle East before this conflict began. They didn't know exactly what the plans were, but obviously they could see tensions rising. They positioned oil overseas. The previous administration wouldn't even talk to them or engage with them.
Yeah, so 100 million is a lot, but it's only 1 day of global production. I mean, that's kind of what we use every day.
Yeah, but it's not the what matters is the degree of the interruption, right? And this is a large interruption. Round numbers, maybe as much as 15 million barrels a day. So 100 million barrels, I look at as a week. That's an extra week beyond global stocks, beyond floating storage, beyond our strategic petroleum reserve.
Sarah?
You're right. It's Sarah Eisen in the studio. President Trump just suggested that, under these negotiations, we could see a scenario where the U.S. and Iran jointly control the Strait of Hormuz. I'm curious how that would work and what the plan is.
Well, look, these are early on in the negotiations. I certainly don't want to get ahead of the president there, Sarah. But clearly the world has seen allowing Iran to control the Strait of Hormuz, as they have on and off for decades, is just an unacceptable outcome. We need to have an end with some assurity that you can have free flow of shipping traffic in and out of the straits. Not just for the United States, but for all the Gulf nations, certainly all the nations of Asia and Europe and around the world.
So is the way this ends...
Was there an
Oh, I'm sorry. I just wanted to follow up. Is the way this ends in the U.S. victorious, that they no longer have the control over the Strait of Hormuz?
Well, their country's still going to be there, but we need to be in a position where their ability to threaten the Straits of Hormuz is either gone or dramatically reduced from where it's been the last few years, the last several decades.
So if this war were to go on, and let's all hope for we all want a speedy outcome, okay? We're seeing a sale from the SPR. Some of that's already been delivered very quick.
Yes.
Okay, but with the previous administration's sale from the SPR, there was some worries that the functionality, is the SPR broken? Is the mechanism for getting stuff out broken? Could there be another release? We're starting to drain it, by the way. Could there be another release from the SPR if needed?
Well, of course there could be. I think that's highly unlikely. Two things on that. They did damage the Strategic Petroleum Reserve in 2022. So we are drawing from only 3 of the 4 storage caverns. That is unfortunate. Also, they sold the oil, took that money, put it into the federal budget, and spent money on their Green New Deal to further drive up the price of oil. We're doing something very different. We're not selling those barrels, we're trading those barrels. We're trading a barrel for delivery in the near term for over 1.2 barrels of oil for delivery back to us later next year. So we'll end out with a Strategic Petroleum Reserve that has more oil in it at the end of next year than it does today.
The American consumer probably doesn't care about the price of oil, but they care about the price of gasoline or maybe heating oil if they're in the New England area. You've got the audience right now, CNBC's huge audience. You could speak to them directly. Gasoline prices back to 2022 levels. They're at $5.56 in parts of California and Washington State and Hawaii. What is your message to the American people right now about what we can still do to bring gasoline prices back down?
There's things we can do on refinery efficiencies. There's a few more levers we have to pull there that we're looking at quickly. The goal, of course, is to get them down as quickly as possible. But my appeal to the American people is we've had 47 years of threats from Iran, which have artificially raised energy prices for decades. We're going through a short-term period of disruption right now, but the long-term benefits will be enormous. Think of years ahead and decades ahead for you and your children. You're going to see a much better world. You got to get through a few weeks of disruption, and we're doing everything we can to mitigate those disruptions.
Well, you got every major oil and gas producer in America, some, by the way, in the world that are in this room today, tomorrow, Wednesday. This conference, so critical. I'm sure you've got meetings planned. Feel free to share some of that information if you'd like to. Are you going to ask them if they can or will increase production if called on to do so?
Oh, absolutely. The American oil and gas industry is extremely patriotic. In fact, we've had people reach out to us. Look, we're a patriotic industry. If there's things we can do to help the United States, we'll do them. And they are doing them. This is turnaround season for refineries. People are doing less turnaround, keeping the refineries running at higher capacity than they normally would in the spring. People are looking and bringing creative ideas about how to grow their oil production. Chevron's already grown their oil production in Venezuela. So the industry is rallying to the cause as well.
It's like you read my mind, because I was going to wrap it up by asking you about Venezuela. Where are we on Venezuela? I know it's a different type of crude oil. Diesel fuel, by the way, a major issue. Maybe talk about whether or not we're going to limit diesel fuel exports. Feel free to address that as well. And then where do we stand with Venezuela today and in 1 year from now?
Yeah, so Venezuela, right before the U.S. intervention, was producing a little less than 1 million barrels a day. And today, Venezuela is more like 1.2 million barrels a day. So that's 20% growth in less than 3 months. That's pretty tremendous. And I think it shows how much upside there is in Venezuelan oil production. So excited about that. And of course, when a lot of our refineries were built, Venezuela was the biggest exporter of crude in the world. So we're tuned to that Venezuelan Marais heavy oil crude. So more of that heavy oil into our refineries absolutely helps produce more diesel fuel on the heavy end, but of course jet fuel and gasoline.
Is there a price
well.
of diesel where we would limit exports or block exports of diesel?
You don't want to interrupt the free flow of energy trades. China got right out front and said they're blocking exports. We refine more oil than we can consume. If we blocked exports, we'd have to turn down our own refineries and produce less oil and less refined products. That wouldn't be productive for the United States, certainly wouldn't be productive for the world. We do have some ideas on diesel that we can bring extra diesel to the marketplace, and I think we'll see that happen before too long.
Just south of here, I'll wrap it up, just south of here, ExxonMobil and Qatar Energy have a joint venture called Golden Pass. They're going to be exporting liquefied natural gas. Qatar Energy's the biggest natural gas LNG plant in the world is now offline, and it may be offline or partially offline for years. Does that impact at all Exxon's plans south of here with Golden Pass?
Oh, that'll be on in the next few weeks, if not the next few days. So no.
Next few days?
Yes. That plant is very close to being operational. These are long, multi-billion-dollar huge projects. But yeah, Exxon and Qatar Energy are great businesses, very savvy in LNG. But yeah, you'll see continued growth from U.S. LNG to fill that hole. That's President Trump. President Biden had a pause on LNG export approval. Think of where the world would be today if we had a Harris administration still throttling American oil and gas production. Think where the world would be without that LNG. American LNG production is growing rapidly and will continue to grow rapidly to the benefit of our country, to the jobs in this country, and to the benefit of the world.
Like you said, though, I know some of these plans have been put in place for years, and hopefully the plans now will lay fruit for the future. For that, we'll leave it. U.S. Secretary of Energy Christopher Wright, really appreciate your time, sir.
Thanks, Brian.
Thank you very much.
Pleasure to be here. The future for energy in America is bright indeed. I can guarantee everyone that.
Well, maybe the price is down today, but still up from where it was. And this is the capital, David, of where everything is happening in the world is right here in Houston. We'll be here all day today, all day tomorrow. A lot of big guests. Back to you.
All right, Brian, thank you. Brian Sullivan at CERAWeek. Much more on the latest in the war in Iran ahead. Former Defense Secretary William Cohen will join us, weigh in on the latest developments. First, though, it's a dark horse in the race to capture the weight loss drug market. We're going to talk to the CEO of Structure Therapeutics. This fresh off very strong data around the company's latest entrant for weight loss pills. Of course, it's phase 2 data. We'll explain when we come back.
Powerful rally on Wall Street. The S&P is up 2%. Dow's up almost 1,000 points. Every sector is higher. This after President Trump said there have been some positive steps in a negotiation with Iran toward ending the war. And the market is rallying. Oil prices are falling, David. And it is pretty widespread, but consumer discretionary is at the top of the pack.
All right, let's move on to a biotech company. It's named Structure Therapeutics. It made headlines last week in the weight loss drug space. The company released promising new data from a mid-stage trial for its oral GLP-1 candidate, showing up to roughly 16% weight loss with no signs of plateauing. The company now gearing up for later stage trials. Joining us now in a CNBC exclusive is Ray Stevens. He's the CEO of Structure Therapeutics. Nice to have you here.
Thank you, David, for having me on the show.
All right, so you move on. Obviously, a lot of people looking at that data, but also some wondering, well, given the presence of Novo with its oral already, and Lilly about to have a small molecule oral on the market, why do we need another one from Structure?
So if we look at the history of drug discovery, it's shown us over and over again. For example, statins. The first statin from Merck, Mevacor, Zocor. The statin that really took the market share, Lipitor. We've seen this with the GLP-1s. It wasn't the first GLP-1, second or third. We see multiple generations. What wins at the end of the day? Best in class. We showed with our data last week, best in class efficacy, 16%, still going down. And we also had very low single-digit discontinuation rates.
And it's a small molecule, which I think may be lost on some people, but is important, I guess, when it comes to the cost overall of manufacturing and any number of other issues, correct?
That's correct. So one of the things that what we have over the kitchen sink at work, why we started this company, make medicines more accessible to everybody, to all. And so we spent a lot of time on manufacturing. We're really pleased with our manufacturing process, so we can make this medicine truly accessible, affordable to all those that need it.
Well, actually, when you say that, what are you thinking? Now, you're a ways away from coming to market, obviously. You still have phase 3 ahead of you.
Correct.
But when you talk about affordability, because it is a key consideration for the GLP-1s that are already out there, what are you thinking?
We continue to work on our manufacturing. So right now we're very happy with our cost of goods. We'll continue working on that. We have time. But right now we're laser focused on phase 3 execution and making sure that we can conduct this study and have the best possible data at the end of the phase 3 before we go to market.
All right, but you do seem to be indicating that you can obviously compete not just on efficacy, but on price?
We believe that we can compete in multiple ways. Best in class efficacy, low single digit discontinuation, and price.
What is the difference of your pill versus the Lilly and the Novo pills? Is it a different technology? Is it different efficacy? How do you compare them?
Yeah, oral Wegovy is a peptide, so they still have refrigeration. There are dietary restrictions. 4 ounces of water in the morning. You shouldn't eat anything, for 30 minutes. Orforglipron from Eli Lilly, we think it's a very good drug. We believe that aleniglipron, our medicine, is best in class in efficacy. It's best in class in off-target safety, as well as manufacturing. Again, we're really pleased with our manufacturing process, to get to David's point, cost of goods, and combinability. We can combine this with other mechanisms, such as oral amylin small molecule that we also have in clinical trials.
Yeah, is that a combination therapy, or does your drug stand alone? Why develop the amylin side of things?
Yeah, absolutely. So first of all, our aleniglipron, our oral GLP selective molecule, that's for monotherapy, and it works really well, 16% best in class. There are some people, though, that don't respond to GLP-1s. I feel for those people. And so amylin is a different mechanism, potentially better tolerability, potentially better selective weight loss, and for those that cannot, that GLP-1s do not work. So those reasons, and then for those that want even more weight loss, most people want 10 to 12% weight loss. But for those that want more, by combining GLP-1 with amylin, we see even more significant weight loss.
Ray, there are no shortage of companies conceivably would be interested in buying Structure. That certainly is a part of why your stock price has performed as well as it has, in addition to this latest data. I know there is interest. What is your response to that interest?
Yeah, there is interest. Right now, we are laser focused on impact, building value. We have a phase 3 in front of us. We need to make sure that phase 3 is executed as well as possible. We've done more phase 2 studies than anybody characterizing a GLP-1 drug. We are ready for phase 3.
All right, but you don't have a sales force, right? I mean, you're starting manufacturing. The history of companies like your own is typically when you get to this point of success that you already have reached, you sell.
Yeah, absolutely. So partnership is certainly on the table. We would like to find a partner that can help us. We feel we can do chronic weight management. The FDA had new guidelines last year, that highlighted with clarity the guidelines for chronic weight management. But there are so many other indications, liver disease, chronic kidney disease. We would like a partner to help us with expanding that. And of course, to your point, commercialization, we want to make this medicine be accessible to as many people as possible. We do that with a partner.
Right, so not necessarily a sale, but a partnership as well.
Correct.
We'll see. All right, we're going to monitor that closely. Thank you for joining us, Ray. Appreciate it.
Thank you very much, David. Appreciate being on the show.
Thank you. Former Defense Secretary William Cohen is with us next. His take on whether an end to the Iran war is really in sight. He's going to join us when Money Movers begins after a quick break. Good Monday morning, everyone. Welcome to Money Movers. I'm Sarah Eisen with David Faber, live from Post 9 of the New York Stock Exchange. Carl Quintanilla is off today. President Trump saying the administration has had, quote, very good and productive talks on ending the Iran war, fueling a big rally on Wall Street. We are joined by former Defense Secretary William Cohen to discuss the military and diplomatic options currently at play.
Plus, CNBC just spoke with the CEO of a top U.S. energy producer and supplier reacting to the president's remarks and what it could mean for prices. Those comments from the CEO of Constellation Energy will be coming up.
And the Magnificent Seven fueling big market gains over the past few years, outperforming the S&P. We'll ask one top strategist whether it's time to consider getting out of the mega cap tech trade. First up, though, in the markets, we've got a big rally on our hands here. 2% higher on the S&P, more than 2% on the NASDAQ. Stocks are roaring back, especially after overnight. I mean, before the market open even, they were down as much as 1%. The trigger, President Trump coming out first on social, then speaking to media reporters that there have been productive steps in negotiating with Iran, a potential end to this war. Oil prices are falling hard, down 10% on WTI, and treasuries are rallying. It's the whole anti-inflation trade really kicking in, and consumer discretionary stocks are getting the the best performance today, the travel names, those that would be sensitive to these higher gas prices if things do go the other way here.
And they obviously are, and that is solely because of course, as Sarah said, both the Truth Social post, but more importantly, more detailed comments that we got from the president. Let's start with the latest on that and the comments for a potential ceasefire. Eamon Javers is in Washington with the latest. Eamon.
Yeah, good morning to you, David. President Trump said this morning at Palm Beach International Airport that he will delay bombing Iran's power plants for a 5-day period based on talks that he said are being conducted with the top person in Iran without naming that person. Now, Iranian state media, bear in mind, put out a statement this morning saying there have been no negotiations and describing all of this as President Trump simply backing down. But here's what the president said this morning.
We're doing a 5-day period. We'll see how that goes. And if it goes well, we're going to end up with settling this. Otherwise, we'll just keep bombing our little hearts out.
Now, in those comments to reporters, the president also said he envisions joint control of the Strait of Hormuz if these negotiations work out, with control being shared by, quote, me and the Ayatollah, whoever the next Ayatollah is. Now, through the weekend, we've been following all this, largely getting information on the war in Iran through the president's social media account, which has been something of a head-snapping exercise. If you can follow along, on Friday at 9:43 a.m., the president wrote, "The fight is militarily won." Then on Friday at 5:13, he says, "We are getting very close to meeting our objectives as we consider winding down our great military efforts in the Middle East." But then on Saturday, we got this 7:44 p.m. post, the president making a dramatic threat. If Iran doesn't fully open without threat the Strait of Hormuz within 48 hours from this exact point in time, the United States of America will hit and obliterate their various power plants, starting with the biggest one first. And then this morning, this is the thing that triggered the market move today at 7:23 a.m. The president reversed that threat he made over the weekend, saying the United States of America and the country of Iran have had over the last 2 days very good and productive conversations regarding a complete and total resolution of our hostilities in the Middle East. He said that he would delay for 5 days his threat to destroy those power plants. And talking to reporters this morning, the president said there were discussions yesterday that he described as stretching late into the night, but without really saying who participated in those talks or what specifically was discussed. So a lot more to learn on what these back-channel conversations may be and where they may be going, guys.
Yeah, although, Eamon, he did seem to indicate Steve Witkoff and Jared Kushner are involved in these conversations. At least that's what I thought I heard him say. As for who they're with, that was sort of more of a mystery, other than the president saying we're dealing with a man who is a respected leader. But again, to your point, not making that clear. He also indicated, interestingly, that it was the threat to the electricity production in Iran that he said at least brought them to make the call to have talks. Isn't that correct?
Yeah, he said that the Iranians called the U.S., not the U.S. calling the Iranians. He's often eager to suggest that he's not the one requesting negotiations, that the other side is the one requesting negotiations. And David, he put this in the context of a lifetime of deal making. He said, I'm a deal maker. This is what I do. This is what I'm doing now. So you take that sort of as one set of scenarios. And the other set of scenarios is the president was asked about the $200 billion request that the Pentagon is making for more funding for the war. He said it's always nice to have that. And he was asked about U.S. Marines and additional U.S. troops being sent to the region. He said, I'm not going to talk about that. That would be a terrible question for me to answer. So at the same time, the president is talking about winding things down in negotiations. He's also requesting more, keeping the request alive for more funding and continuing to send troops to the region. So keeping up the pressure on that side of the equation as well.
Yeah, I mean, he pointed to Venezuela as, see, we can do this. We can put new leadership in place that'll be more friendly and pro-America. And I think that's the biggest question here, Eamon, is who this man, this well-respected man is, who the leaders are, and is it someone that the U.S. can deal with and negotiate here in good faith? It's unclear who's running the country, right?
Yeah, we just don't know at this point. And the question will be, is Iran going to be able to follow that Venezuela model? The president has said that from the outset of this, and really hoping for a revolution in the streets by the Iranian people that has not yet materialized. Maybe there's some hope that if the bombing campaign moderates, that the Iranian people might take to the streets and replace leadership on their own. But all of that very murky and unclear right now. And so if you're betting on the outcome of all this, what you know is the president is signaling de-escalation this morning while keeping in his, the arrow in his quiver of re-escalating, because we do have that slug of money that he wants, and we do have those ground troops on the way to the region.
They're also sending missiles, destructive missiles to Israel still, which had its 200 people injured over the weekend. Eamon, thank you. Eamon Jabbers. For more on the market, let's bring in Wells Fargo Chief Equity Strategist Oh-Sung Kwon. It's great to have you back. Welcome.
Thanks for having me.
So what do you do with a market like this, which completely turns on the president's statements and negotiations for ending this war?
Yeah, so as of last Friday, we estimated that about a quarter and a half of impact from oil disruption was priced into the equity market, which is largely in line with what the oil market was pricing in. So an adequate amount of risk was already priced into the equity market. And what the equity market was really worried about was a prolonged war. And at least we are moving to the right direction, that it's probably not going to be too long of a war that it completely destroys the economy.
Have you changed your advice at all for clients based on this new geopolitical landscape and all the volatility?
Yeah, so we started to like tech. So we had been almost like outright bearish hyperscalers for the past few months. And I think hyperscalers are starting to look a lot more interesting. And I think what the war did was this was a wake-up call that U.S. equities are a lot more safer and higher quality than international equities. And over the past year, we have seen one of the most extreme outflows from U.S. equity market into international. And I honestly think if we come out of this largely unscathed, this would have been a positive impact for the U.S. equity market.
Why are hyperscalers? Why are they more attractive now?
Yeah, so the reason why we were bearish was because of their weakening free cash flow. And their free cash flow estimates for 2026 came down by about 2/3 over the past year.
Yeah, the huge CapEx obviously contributing to
exactly.
that largely.
Yeah, and our analysts think that we are actually at an inflection point where free cash flow could actually come in above where consensus is. They're actually forecasting a higher CapEx number than consensus, but it's really the sales estimates, the top line growth that people are underestimating. And if you listen to hyperscalers, they're all saying that demand still outpaces supply. And there's a lot of supply coming online. So I think the street is still underestimating their potential top line growth story. And if AI is truly that transformative, then hyperscalers are probably not overinvesting either.
But that is one of the key questions the market has been asking, certainly prior to the hostilities with Iran, is will there be a return on this enormous investment being made by all the hyperscalers, none of which have backed off at all from their desire to be there when that return comes.
Yeah, and I think the equity market priced in a lot of risk around that. So if you look at the NASDAQ, since October, the NASDAQ derated by 25% already. It's actually been one of the most extreme deratings that we have seen in history. So I think equities are already pricing in the downside risk of potential overinvestment cycle. And I don't think hyperscalers are necessarily overinvesting. It's just kind of like there might be a little bit of delay on the return on investment, but if AI is really that good, and we're just going to need more compute power too. So if that's the case, I think hyperscalers are starting to look more attractive here.
What about on consumer? Do you go with the cyclicals or you go with the staples right now? That's been kind of, market's been flip-flopping on that one.
Yeah, we're actually underweight both consumer discretionary and staples as well. We like the tech and commodities barbell trade here. So tech obviously derated that we just talked about. Commodity cycle, I think it's still pretty healthy. I mean, yeah, oil's getting hit, but energy companies, they are still looking pretty attractive from the valuation perspective and the earnings revision cycle. And materials too, we're overweight there as well.
Commodities, you like the energy stocks no matter what, whether we're in a war or not?
Yeah, so we actually double upgraded energy back in November, and we were bullish more on the reflation cycle that I think this is really a restocking cycle of the PMI upcycle that we started seeing after 3 years of destocking cycle that we saw. And the best way to express the restocking cycle historically has been through commodities.
All right, well, energy is the best performing sector of the year, up 32%, but that's with the big spike. Oh-Sung, thank you very much for joining us.
Thank you.
Appreciate it. From Wells.
Still to come this hour, CNBC just speaking with the CEO of a top U.S. energy producer, reacting to the president's remarks about pausing strikes in Iran and what that could mean for oil prices. We're going to bring you those comments next.
Plus, we are joined by former Defense Secretary William Cohen with the latest on the potential military strategy here in the Middle East. Money Movers back in just a moment.
Welcome back. Oil plunging this morning. This on the president's comments about a pause in strikes against Iranian energy infrastructure. For more on the war and the path forward for possible negotiations, let's bring in William Cohen. He's a former Secretary of Defense under the Clinton administration. Good to have you, Mr. Secretary. I assume you heard the president's comments this morning. I guess, first off, just love to get your reaction to them.
Well, I was relieved. I think we were escalating at a level and a pace that was really very dangerous to us, to our troops, to the region, and to the world market. And so I was pleased to hear the president at least step back for a pause. Now, whether that pause is for buying time to get our Marines really ready to go in and take over Cork Island or not, or whether there are some discussions taking place behind closed doors that find some kind of a pathway to a peace in the Middle East, one that will carry risk. But the question becomes, how much is the United States, Israel, the countries in the region willing to tolerate? Because there's never going to be absolute security. but what is the risk level that they are willing to live with? And that's something we have to be negotiating and talking about. So I'm pleased that the president has paused at least for 5 days.
Yeah, well, he made it clear in his comments, at least, that there are negotiations taking place and that there seem to be areas of agreement. Here, and again, I'm basically wrapping up what the president said. And much of it focused, Mr. Secretary, on denying Iran a nuclear weapon. And in fact, it would seem he did also discuss the U.S. taking control in some way of the enriched uranium in the country.
That has been one of the goals, to always prevent Iran from getting a nuclear weapon. How close they are to one, we really don't know. It's estimated they have about 1,000 pounds of enriched uranium that could be converted quite quickly into a nuclear weapon, and then have a delivery system that could deliver not only the region, but to Europe and the United States. So I think it's really a question of what are the Iranians willing to do. We have discovered, and the Israelis have discovered, that we're not able to dig them out. They are so deeply embedded and dug into the country of Iran, the governance of Iran, that you'd have to go in with fixed bayonets to dig them out of foxholes equivalent, or having ICE go around and break every door looking for IRGC members. Very tough and tall order. So I think we have to be careful. The Marines can carry out the mission. There's no doubt about that. And I have to just pause here to say thank you to our military, to the best military in the world, the most efficient, capable, highly educated, trained, along with the Israeli Air Force as well. But we have seen the kinetic power of the United States. Now we have to see what kind of soft power we have, what kind of negotiating tolerance we have, what kind of compromises are we willing to live with, both we and the Israelis, who have, I think, a very different objective than does the United States at this point.
Yeah, and are still getting pounded, as I mentioned, including over the weekend. So who do you think we are negotiating with over there?
I don't know. I have no idea who our negotiators are. It's rumored to be Jared Kushner and others, but I have no way of knowing this, and I certainly don't have any way of knowing who the Iranians would have. I assume we are working through the Omanis. The Omani leadership over the years has been a moderating force in the region. They talk daily and have talked daily to the Iranians. And so I assume that whatever negotiations are taking place, using them as the medium and the communicator to our positions and to those of the Iranians.
Yeah, I mean, I guess the question is who is calling the shots over there? Because the Strait of Hormuz is still effectively blocked, right? They are controlling that. There's still missiles coming over, not as much. So how do we judge the success of the operation?
Well, it's going to take some time to negotiate that. It's going to take forces in the region. I am hoping that we don't have to deploy the Marines to take over Cargo Island. Marines are great at carrying out whatever mission we give them, but simply taking the island and then occupying it is not a mission that they're normally accustomed to. The Army and others for that particular purpose. But we would have to fight our way in and possibly fight our way out. And we'd have to go in by air and not by sea, going through the strait to get to Cargo Island. And the Marines would come under heavy fire. They'd be very exposed during that time. And so this is not going to be a bloodless type of occupation if that's what we decide to do. And I'm hoping we don't have to. But if we do, the Marines will carry out that mission. But the question will be, what is the cost in blood? Certainly in treasure. What is the cost in blood? Those young men and women are our prime asset. We have great equipment, great military capability, but the most precious thing we have are the young people, the men and women who are serving us. And you ask any military commander, if you had a great weapon or a great trained, highly trained and prepared soldier, what would you take? They would take the soldier every time. And that's what we have to be careful of, preserving that treasure we have.
Finally, Mr. Secretary, I know it's been a while since you've been around a military budget, but nonetheless, you mentioned costs. I mean, what is your sense as to what this is all going to cost? And here I am talking purely about monetarily.
Well, we've already spent close to, I would assume, 15 to 20 billion. and the president has asked for 200 billion more. I think Congress is going to say, tell me why now? What's the mission you want to accomplish with this 200 billion? And can we accomplish the task? And final thing, we need to treat Congress as a co-equal branch of our government. If I were in Congress, I would demand answers to all of these questions if you're asking me to come up with 200 billion. If I were at the Defense Department, I'd be willing to tell them, I want Congress on my side. Can't have a divided administration and a Congress when it comes time to the lives of our servicemen and women and to all that we portend to and hope to protect in the region, in this country, in Europe. We have to have a real cooperation, collaboration, Congress and the administration. That has to take place.
All right. William Cohen, thank you. Appreciate it.
Thank you.
Later this hour, the EU's new competition chief set to meet this week with CEOs of Google, Meta, OpenAI, and Amazon. Her first U.S. trip this year. She's going to join us ahead of those meetings.
Then ICE agents deploying to airports around the country. This is TSA agents face another missed paycheck. Plus, we're going to get the latest on that deadly crash at LaGuardia Airport, a plane colliding with a fire truck on the runway. LaGuardia closed down for a significant amount of time as well.
Oh, those images.
Yeah. Don't go anywhere.
Welcome back. As energy prices plunge, CERAWeek kicks off. The world's top energy executives all gathering in Houston, Texas. Of course, that is where we find our Brian Sullivan speaking with some of the key leaders in the space. Good morning, Brian. It's been an active one already.
Yeah, is it a good morning? I mean, it's morning. It's been very busy, to your point, Sarah, but it's a critical time, and we're glad to be here at the CERAWeek conference. But it has to be global because every major oil and gas CEO in America, many of them in the world, are here. Although I will say that there are some CEOs, say Abu Dhabi National Oil Corporation, ADNOC, had to address the conference virtually because they may not be able to either get out of the Middle East, it's not safe to do so, or they can maybe make it to Washington, D.C. It is a hectic travel time as well. Listen, everybody's conversation last night, so far this morning, long way to go, has been on one thing: the war and the resulting impact on energy costs, whether that's oil, whether that's gas, or whether that's straight up electricity. And I want to be clear, CERAWeek has largely been thought of for years, been going on with Dan Yergin and crew for 20 some years, largely thought of as oil and gas, but there's wind, there's solar, there's battery, there's the all-in energy theory. A few minutes ago, we had the opportunity to sit down with Constellation Energy Group, CEG. Look at it, I say it and the chart pops up. Their CEO, Joe Dominguez. And I asked him a question that I think that Sarah, you and David and myself and all of our viewers want the answer to, which is very simple. Why have electricity costs gone up so much in the last few years?
The biggest part of the increase over the last 15 years is in the wires side of the business. As natural gas has been fairly stable, as you said, the cost of power has been fairly stable. In contrast, distribution charges for the wires, transmission charges for those big power lines, those things have gone up something like 70% and 300%. So we've done a lot on the wire side of the business to improve reliability. We've got to be a little bit smarter about how many investments we can continue to make now that we're achieving that high reliability. And we've got to be thoughtful about how we integrate large load in a way that actually brings prices down.
So what he's talking about, the wireline side of the business, it's just getting the power. You can build a solar factory, you can build wind turbines, you can build whatever it is, battery backup, but you've got to get the power to where it needs to go. And I think the question that I've got here for the remaining guests we have over the next 2 days, guys, is also one that goes to AI, because that was the theme before the war began. And is there any chance that what we're seeing in the Middle East, and I know nat gas prices down today and they're way cheaper than they are overseas, will that hurt the AI build out because it increases the costs on data centers? So far, people have been saying no, but I think it's still a macro question that will outlast whatever happens in the Middle East.
Brian, thank you. Brian Sullivan, of course, at CERAWeek. Here, every week is CERAWeek.
Oh, what a good joke.
Like that?
This is CERA.
I know. I just
Here it's SARA.
I couldn't resist.
But I really enjoy it.
I couldn't
What
resist.
a good time for CERAWeek, by the way, with the price of oil right now.
Yes.
Plunging
Plummeting.
13% on these Trump comments.
Yeah, with the S&P up some 2% and the NASDAQ above that at a 2.3% gain. All right, let's get a CNBC News update. Angelica Peoples has that for us. Angelica.
Hey, David. The Supreme Court this morning is hearing oral arguments on the issue of mail-in voting and whether states can count ballots that are mailed by the deadline but don't arrive until after Election Day. And this case comes as President Trump pushes a bill in Congress which would require proof of citizenship to register to vote and photo ID to vote. It would also put limits on mail-in voting, a process that the president has repeatedly railed against. Police in London are investigating what they're calling an anti-Semitic hate crime. 4 ambulances belonging to a Jewish volunteer emergency service were torched in an arson attack, and no injuries were reported, and there have no arrests have been made at this point. David Simon has died. The real estate developer turned his family's business, Simon Property Group, into the largest mall owner in the country. He was diagnosed with cancer in 2024, and the company announced this morning that his son Eli will become the company's CEO and president. David Simon was 64 years old. David, back over to you.
Yes, some very sad news, Sarah. Of course, you and I both knew David Simon, who has been, as Angelica said, battling cancer for some period of time. His son taking over, but Simon Properties, obviously one of the most significant mall operators, if not number one, in terms of A-class malls. And he obviously ran that company and ran it quite well for a very long period of time.
I know. I just looked at IPO in 1993. He was 33 years old, took over the company, and cumulative shareholder return of more than 4,500%. You know, he's had an incredible run, and also got Simon into real estate, got them into retail, all sorts of innovative deals. I think that's probably how you know him. He was considered a tough person, to go up against.
Oh, he was. They bought Taubman.
Deals.
That was tough as well when they wanted to cut the price. I can remember that. But I did recently see him in the fall and very much enjoyed his company. And obviously, my condolences.
I know. It's very sad. He was too young.
To his family and his lovely wife as well.
Yeah, I'm keeping it in the family, though. But of course, we send our condolences. The entire business world, I think. A lot of people knew him. We'll mourn David Simon. We'll be right back. Welcome back to Money Movers. Our next guest telling investors to reduce exposure and take profits from the Magnificent Seven. Magnificent Seven composite lagging the S&P year to date by roughly 6% or so. He's also advising investors to lighten up on U.S. equities overall. Joining us now is Research Affiliates founder and chairman Rob Arnott. It's kind of a different take than we've had actually so far on the show. We've talked to a Wells Fargo strategist who likes the hyperscalers now and says the market's underappreciating the top line growth there. Rob, what are you thinking these days?
Well, firstly, the Magnificent Seven are all magnificent innovators. They're revolutionizing our future. Now, prices are set based on narratives. This is the narrative that fuels the rise of these companies to a collective value north of 20 trillion at the start of the year. Narratives have the advantage of being largely true. They have the disadvantage of being entirely reflected in share prices, so they don't help us as investors unless we can identify flaws in the narrative. I think there are two. One is that these companies all have a moat that will protect them from competition for many years. The other is that the company's innovations will see vast and rapid adoption and deliver enormous near-term profits.
So what do you think? Why does that not make you like them, the entire equity market right now? Or do you think it's just because they've been such heavy weights in terms of market cap?
Well, the U.S. stock market, I like to use the Shiller PE ratio, price relative to 10-year smoothed earnings. And the Shiller PE ratio for the S&P 500 topped 40 a couple months back and is hovering at around 39 now. That's extremely expensive. The historic norm is less than half that. Europe, Japan, emerging markets are all priced at 15 to 25 as a Shiller PE ratio. So the US is expensive. I'm not saying get out. I'm saying take some profits. Just like we like to average in to bargains, averaging out of our successes makes a lot of sense. That's the only way to assure that you won't ride down the winners that gave you such nice gains.
Into what? Does something else look more appealing right now?
Well, I think the appealing markets are, firstly, in the US, small cap value. Now, during the dot-com bubble, it was interesting that the 2 years after the bubble burst in March of 2000, the next 2 years, the NASDAQ was down over 50%, the S&P was down over 25%. Russell value was slightly down, I think 4%. Russell 2000 was up 3 or 4%. And get this, Russell 2000 value was up 53%, while NASDAQ was down over 50%. So you would have literally tripled your money relative to the NASDAQ investor if you were prescient enough to pivot at that moment. You can have bargains go up even in a bear market. And so I think in the US, small cap value is the place to be. Outside the US, international and emerging markets value are the places to be. Now, nobody can pick the right entry point. So average out of your winners, average into what's newly out of favor. And one aspect of this that's interesting is averaging into bargains is painful. You're buying what's caused misery and losses, and nobody wants to do that. But it's the nature of bargains that they will have inflicted pain and losses on their way to bargain pricing. And that's where we are today for small cap value, for emerging markets and international value stocks.
Finally, Rob, I do want to come back to your view on the Mag 7 and the flaws that you cited in the narrative. You said two. I think one was that the idea that they have a moat that will protect them from competition, and the other being that their innovations will see vast and rapid adoptions. Why are you questioning either one of those narratives?
Well, the dot-com bubble illustrates the problem with both of those aspects of the narrative. Not one of the 10 most valuable tech stocks in the world in 2000 had a moat that fended off competition for even a decade. All 10 lagged the S&P over the next decade. Only one, Microsoft, outperformed over the next quarter century by 2% per year. That's the only winner. The other 9 lagged the S&P, half had negative returns, 2 disappeared with essentially 100% losses. What about Apple and Amazon? Huge winners in the last quarter century. Well, they were small in 2000, not even in the top 25 tech stocks by market value, let alone top 10. They were the disruptors who vaulted over the top dog's moats. Apple was 36th ranked at a time when Nokia was ranked number 5 in the world for market value. 36th versus number 5. Now, where's Nokia today? I don't know. It's probably not even in the top 250. But Apple, of course, is in the top 3. It pogos around in that ranking. So the other aspect, the fast adoption, the simple fact is that the world of 2005 looked an awful lot like the world of 2000. After a quarter century, that's not remotely true. The promises of vast change from the internet have proven true, but it wasn't in 5 years. It was more like 10 to 20 years that but human beings adopt change only gradually and grudgingly. And that shows up in the dot-com bubble. I think it'll show up in AI adoption, which is in fact huge. But the industry needs to figure out how to monetize the most important innovation since the computer. They will, but that's still a work in progress. The industry offers AI to end customers for near zero pricing. That's going to change, but they have to figure out how to make it change.
All right, something to think about. I mean, certainly the historical precedent is there. Rob, thank you for joining us. Appreciate the view today.
Enjoyed it.
Rob Arnott, Research Affiliates founder and chairman.
Yeah, we're on that at some point. We'll have to bring him back. All right, speaking of America's largest tech companies, the EU's new competition chief will be with us after the break. This is our first U.S. trip of the year. One question, of course, is how potential regulation will impact the growth of AI. That's when we're back in 2 minutes. The European Union's top antitrust enforcer set to meet this week with the CEOs of Alphabet, Meta, OpenAI, and Amazon. This is her first U.S. trip of the year. Joining us now is the EU Competition Commissioner, Teresa Ribera, along with our own Deirdre Bosa. Dee, take it away.
David, good morning. Thank you very much. And Commissioner Ribera, welcome to San Francisco. Thanks for making the time.
My great pleasure.
So as David said, you're meeting with the CEOs of some of the companies, the big tech, the ones at the forefront of AI. What is your message to them? What do you hope to accomplish?
My message to them is that we need AI happening because that creates lots of opportunities for the economy, for the households, but we need it to happen in such a way that does prevent a kind of huge concentration of power, undermining the possibility to challenge, to innovators coming up with new ideas. So how we can do that, how we can work together, is one of the main questions to be raised in these conversations.
And what do you hope to achieve? What message do you want to hear back from them?
Well, I would like to have a better understanding on how they see themselves, on how they can contribute to a larger prosperity of the humankind without undermining the possibility to respect rights and to respect freedom of speech and to respect creativity coming from others. So not self-preferencing always themselves.
Right. I guess some of the fears, too, is that if you pause for regulation, you slow down in this global race, particularly against players in China that are moving very, very quickly. So what's your message to them in that to prevent sort of a monopoly, but also to enable them to move quickly?
Of course, security, ethics, development come along together. And it is true that working on how we can ensure a level playing field is key, but it is not the only concern. Cybersecurity, as you have been saying, is quite an issue. But I say also that the respect of rights of others, including competitors, is key. So interoperability, capacity to train the algorithm with the right data is quite key, allowing others to get this data, to keep on ensuring sound information, working on AI agents that could be, how to say, controlling, developing the capacity to assess and advocate for different tools, instruments, and contents is very key. And this is why I thought that it was so important to have a candid conversation with them all to ensure that to the extent possible we are properly aligned. Big tech in the US are doing fantastically well, and yet China is going at the high speed in this field. And I think that ensuring that we can keep an eye on how things may evolve is very important.
You get to the stakes of it with things like agents, where there are more security concerns. The EU, though, has been more aggressive in regulating American tech companies, certainly over the last decade. Has anything structurally changed for these companies? Why should anyone believe that regulation will shape how they build AI when we've got fines, but I'm not sure if we've got actual structural change for these companies, even over in Europe?
Well, I think, in fact, it has been quite a success. It was not intending to target any type of company depending on their nationality, but to ensure that anyone willing to provide and to accept to the digital reality can do on a level playing field basis. And in many cases, it has been small American companies trying to get this competition, this fair market functioning, because European market represents around a third of their global turnover. And it is true that we have achieved lots of things thanks to this regulation that was developed at the beginning during the Trump 1 administration, so working together with our American counterparts that have similar approaches in terms of how they can ensure this market well functioning all over the world. And yes, we were focused on interoperability and access to data. And there are lots of small things that have been improving for any consumer thanks to this way to work, anticipating what it must be respected, what are the things that they can do, what are the things that we expect them not to do, and how we can work together thanks to the specifications that we develop together on how to improve the quality, the transparency, and the openness of their proposals through the platforms, through the cloud, and so on and so on.
Commissioner, I do want to ask you about energy because it's part of your mandate, and it's a lot of what we're talking about on CNBC today. Does the Iran war prove that the EU's bet on clean energy was right, especially as the U.S. has pulled back on clean energy under President Trump, and thus more vulnerable to these rising oil and gas prices?
Well, in fact, what we have seen is that those countries that have advanced much more on electrification and clean electricity are better placed today. The wind and the sun do not get stuck in the Strait of Hormuz. But it is true that what we have seen, and these are figures being provided by the director of the International Energy Agency, what we have been witnessing in 3 weeks is the destruction of production of oil and gas equivalent to the whole destruction of oil taking place in the 2 crises of the 70s, plus the heavy impact of the invasion of Ukraine on natural gas global market. So it is very important not only for the energy markets as such, but also in terms of fertilizers, electricity that do connect to gas prices, chemical industry, and so on and so on. So we may be facing a huge impact not only in the global economy, in every single nation, but also in households. It ends in our kitchens, it ends in our bills. So yes, it is a very relevant point of concern, and I think that this explains why whenever there is a hope to go down, to slow down this bombing, markets react positively, and why when the bombing takes place once and again, markets react in a very worrying manner.
Yeah, we've certainly seen that volatility in real time. Commissioner Robert, thank you very much for spending time with us today. David and Sarah, toss it back to you at the New York Stock Exchange.
Okay, thank you, Deirdre. Deirdre Bosa. Coming up next, ICE agents deploying to airports around the United States as TSA agents face another missed paycheck. What travelers need to know about all this next. Then we'll have more on that deadly crash in LaGuardia Airport. Airport is still closed right now. We're back in a moment. Welcome back. As TSA agents face another missed paycheck, ICE agents are now being deployed to airports across the country. Phil LeBeau has more. Phil.
And Sarah, we'll talk a little bit more about what's happening with the ICE agents at airports around the country, but I quickly want to bring you up to speed in terms of what's happening with the runway collision at LaGuardia Airport. Remember, 2 people, a pilot and a co-pilot, were killed when their plane, Air Canada jet, collided with a fire truck that was crossing their runway. The airport is closed, expected to be reopened at 2 p.m. The NTSB is investigating, and by the way, the FAA administrator, Brian Bedford, he said just a few minutes ago on social media that he is also headed to New York. Meanwhile, as you mentioned, Sarah, ICE agents are being deployed around the country. We're not seeing a ton of video of these ICE agents, and it's not entirely clear what they're doing at all of the airports, but we are seeing them. This is in New Orleans, and we've also seen some social media postings from Chicago O'Hare where they are assisting the TSA in some fashion, and this is all because the president said, look, something's got to be done to help out the TSA with the call-out rates. And speaking of helping the TSA agents who have not been paid in almost a month, Elon Musk said, hey, I'll pay them. Whether or not he is legally allowed to remains unclear. But here's what the president said when asked if he would approve of Elon Musk paying TSA agents.
I think it's great. Let him do that. And I want to thank ICE because they stepped in so strongly. They'll do great. And if that's not enough, I'll bring in the National Guard.
Quickly take a look at the airline stocks, all up anywhere between 3 and 5% today as we see jet fuel prices perhaps coming down a little bit. Certainly oil prices are coming down, and that would be welcome news for the airlines. Speaking of the airlines, tomorrow we will be talking first on CNBC with Scott Kirby, CEO of United Airlines. We'll talk about his feelings about high jet fuel prices, guys. You saw his message to employees over the weekend. He's expecting $100 for oil through the end of 27. We'll talk with him about that and a few other things tomorrow.
Okay, Phil, thank you. Looking forward to that interview tomorrow. And I am curious, Phil LeBeau, how that would work. Can that work? Can Elon Musk pay the TSA agents?
I'll defer to Phil on that, but I don't believe that's the case, that he's allowed to actually pay. But, executive orders go a long way in this administration, so who knows? I do think it's interesting, Sarah, that the president indicated during, of course, when he was talking to the press, that these agents will not be masked at airports.
Will not be masked, right.
But that remains a key part of the whole debate about why they're not getting paid, because the Democrats are saying they need to not wear masks when they're doing their job in order to allow the bill to pass that would pay TSA.
Yeah, I think Americans just want the TSA agents operating functionally and normally. It's been a crazy market day. Markets holding most of its gains, it looks like, after President Trump said that there have been constructive negotiations, and state media over there continues to deny that, wherever that's coming from, on leadership there. David, thank you. We'll see you tomorrow. Sarah Wake continues. That was the nicest thing you ever said to me. But for now, send it over to Scott Wapner in halftime.
Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, surging stocks after President Trump says talks with Iran have happened, even though Iran obviously denying that. We're trading it nonetheless with the investment committee because stocks are on the move. And joining me for the hour, Joe Terranova, Stephanie Link, Jim Leventhal, and Bryn Talkington. We will check the markets. We're not at the highs of the session, but nonetheless, we obviously have pretty big gains across the board. This was always the risk, wasn't it, that just like Liberation Day, you get all bearish and you have a president whose most critical scorecard is right up there on the board here at the New York Stock Exchange that shows the major averages in the stock market. And a headline like the one we got this morning and the comments that we got from him directly this morning have caused quite a rally.
Well, last year, Scott, the Trump put, if you would, was in the bond market. The Trump put probably was in the oil market in 2026. And I think that's ultimately what we're witnessing right now. We still do not have enough information in an environment where you properly describe it as being binary to make a determination if ultimately this is the moment where we just significantly move higher from here. I do think today is a very important day from two aspects. Number one, first of all, the systematic trend-following funds utilize 3 closes below the 200-day moving average. Today would be the third day closing below. that critical 200-day moving average at 66.25. Do with that information what you wish. It doesn't mean you're going to see significant selling on the close. It just means the overall bias will flip the same way it did last spring, which was the wrong move, and the same way that it did in April of 2022, which was the right move, because following that, you had 149 days below it and 20% down. The other element to all this that I think is important, I take the other side of it. In the last several days, you've seen a significant rise in yields, and you have seen equities that are correlated to that rise in yields. I think this is a tremendous opportunity. If you're looking for value from rising yields, I think yields are going to push lower. I think the notion of a rate hike is absolutely misguided.
I mean, it may be misguided. Obviously, the market.
I actually think you're going to get a rate cut.
The market says that there's a higher percentage of getting a rate hike in June before you get a rate hike.
That's the dislocation. I take the other side of it.
Okay.
I take the other side, and there's things you can do in the market for equities related to it.
Okay, so I just want to give you a headline here because there's been so many things that are happening, and it's a stock market that has come off of its highs, and we should just give you the latest headlines here. That was a post on X first. Iran's parliament speaker says no talks have been held with the United States. The speaker says, quote, fake news used to manipulate oil markets. Goes on to say that the Iranian people demand complete and remorseful punishment of the aggressors. So that is allegedly coming from Iran's parliamentary speaker from a post on social media that has undoubtedly had a little bit of an impact, Steph, on this market. Talks that our president said took place, strong talks, he said, almost all points of agreement. Witkoff and Kushner, the ones who had them, they took place yesterday. They want very much to make a deal of the Iranians. We'd like to make a deal, too, going to get together again today. So you take it for whatever it's worth. I'll just go back to where many people are sort of putting their signposts today. That is a rehash of Liberation Day and the aftermath of, of a president who just doesn't want to see the stock market go down a ton.
Which is not a bad thing, right? I don't believe anything Iran has to say, so I discount that. I actually think that the Trump administration has been very consistent with saying to us, this will be short-lived. Is it 4 or 5 weeks, 5, 6 weeks, but not months, not years. And so if that's the case, in addition to heading into the midterm elections, I think it is going to be less than expected in terms of the time frame. He can't afford to have oil prices and just the cost of living this high and this bad for so many people, especially in a K-shaped economy. The high end can handle this, the mid and lower ends, they just can't. But there's still a lot of unknowns in general, Scott. So it feels good today. It will come down to the timing, but then I always come back and I bore you to tears with the economic data because it's important, because I think we are actually in a better position from an economic standpoint this go round than where we were Liberation Day, where we were 2 years ago, Silicon Valley Bank collapse, where we were COVID. And all three of those instances, we saw massive recoveries, and you had to actually be buying in the uncertainty in general, right? If you wait for the uncertainty to get certain, you're going to miss so much, and you have to think longer term. So traders, totally a different animal. But from an investment point of view, you have to look for big blue chip quality companies that get thrown out with everything else, and that's what I've been doing. I have been buying a lot, and I don't even have a lot of cash. We are way oversold. I would not be surprised to see a couple of days of nice euphoria here, but we're probably going to ebb and flow until we get that timeline. But by then, stocks are going to be higher, in my opinion.
Is this post-Liberation Day buy stocks part deux?
I think
it
is. I think it is. I mean, we're never going to know, as Stephanie just said, until it's well after the fact. But I think the president did just tip his hand. Remember, on Saturday, he said if the Strait of Hormuz is not open in 48 hours, I'm going to bomb power plants. Now, let's be clear. I think there's another 3 to 4 hours before that timeline is up. And darkness is falling over Iran, which is presumably when bombs would start falling. However, we have to give a lot of credence to the fact that he not only hasn't bombed so far, but he put out this tweet saying that things are good. And what what it says to me is that just like on April 9th of last year when he was paying attention to the bond market, Joe, as you pointed out, now he is paying attention to the oil market, and he realizes we're reaching a point of pain past which he cannot expect to have his policies continue to enact it, and that he would probably get blown out in the midterm election. So he is veering course. Now, let's be clear. The Iranians have a say in this. They're not exactly opening the gates to the Strait of Hormuz right now, but that's not dissimilar to last year with the tariffs when he was saying that there are all these deals, and a lot of countries were saying, what are you talking about? So this will play out over time, but he has clearly tipped his hand that he's not going to allow oil to stay at $100 plus per barrel.
You've seen enough that you bought eBay today. You can tell us why you picked that one specifically, but from what I understand, you told our production team it's very much in the spirit of feeling like this is like that was.
It is. I mean, there's an old expression. We've used it many times on the show. History doesn't repeat itself, but it does rhyme. I think that's where we are now. With regards to eBay, this strikes me as a good way to play the discretionary sector for a few reasons. One, the discretionary sector, as oil prices and gasoline prices eventually come down, should see a pickup. But this also appeals to both legs of the K side. There are luxury goods being sold on eBay, but there are also all sorts of refurbished and secondhand goods being sold on eBay. And there's one little lever of this story that is not really talked about too much. This is where collectibles are traded quite often. That's actually a major growth channel. Company trades very cheaply, low teens on a forward multiple of earnings, very little debt, good free cash flow. They really shrink their share count a lot. You know, Scott, I like that. It's a growing company. This is a good place to buy it.
All right, Bryn. So it's your turn. I mean, you know, just playing off Jim, discretionary's up a lot. Airlines, cruises, all the things that got beaten down so badly over the last, 3.5 to 4 weeks are rallying on this news today. So you want to put it all into your own words on how you see this? We'll take everything at this point at face value because the market's moving on what the president had to say. Despite, we're still waiting for some more specifics, but nonetheless, the market's reacting, so we'll react to that.
I think that we'll see what happens by Friday. To kind of build on what Joe was saying on the 200-day, we can handle being under the 200-day for probably 10 days. If you look historically, we need to get above that with the NASDAQ and the S&P to really be able to regain the bull market. And so I think investors need to look at that 66.24 level to see we're under it right now, but we need to get back over it. I think yields also 450. We were making lower highs, and 450 is like the next leg lower on those highs. As long as we're staying below that, I think that also dovetails with the 200-day. We're in good shape. And so I think investors look at the 10-year at 450. You do not want to go above. You want to get above the 200-day. And then going back to oil, I think that definitely everyone's right about oil being an important signal. But understand this is where costs globally are going to start permeating through if we stay in the 80s and 90s for foreseeable future, because 95% of all manufactured goods, a critical component of that is hydrocarbons or petrochemicals. And so whether it's plastic, whether it's synthetic fibers, et cetera. And so that's where you're going to see, I think prices are going to go higher with planes, prices are going to go higher with really anything manufactured, as long as oil even remotely is above 80. And so I don't think we're out of the woods yet. I definitely think there's similarities to Liberation Day, with the exception of that was a manufactured thing by the White House. They had the ability to end it at any time. I still go back to this is existential for the Iranian regime. And so we'll see if level heads, if they even have level heads, can prevail, and the Japanese and our other partners. But I mean, I just think that we're going to have to wait till the end of the week. And I don't think we're really out of the woods, because this is not Liberation Day. This is much more impactful and much more serious.
Yeah, but the de-escalation of rhetoric, at least for the time being, seems to be good enough for, as Stephanie, I think, rightly pointed out, and a pretty oversold or getting to that point market and looking for anything positive to hang its hat on. And it got it this morning, and it's reacting in kind. So, a lot of things that were down are up, as we mentioned, and a lot of things that were up a lot are faded a little bit, like CF Industries. Take a look. The grain trade has been a big one. Joe was on it before. Importantly, it really started to move to the degree that it did. If you pull that out now for a few weeks, you get a look at the swift rise in that stock. which, look, month to date, 20%, right? That tells the story. So what do? I said actually to our executive producer hours ago, I said to Kevin, I bet you Joe sells CF.
Well,
I bet you sell CF. And then
good.
Sure enough, a couple hours later, Kev's like, yeah, Joe just called. He sold half CF.
No, and that's good because you and I have been doing this long enough. We've all been doing this long enough where you understand the discipline that each of us has. I'm not going to sit here and allow what has been a really strong winning trade to turn into a losing trade. So you sell half the position, you hold the other half of the position, and to Bryn's point, you see how things unfold over the next several days, over the next week as you get more information. We are still in a binary environment overall. I do believe it's important to understand as it relates to CF, the material sector and the energy sector. Remember something, this leadership that is being exhibited from these sectors was not established on March 2nd. The leadership really began coming into the year in January and in February. So you had time to build positioning there. And I think on the other side of this, maybe the degree of ownership is important here. Maybe you don't have a significant overweight, but I still think even if we resolve this matter and oil falls back down, I think you want that exposure to energy and materials. The market signaled it ahead of this.
Yeah, what do you think of that? You like it?
I absolutely, completely agree. And there's two sides to this, Joe, because as you know, there was a surplus of production over demand before this all started to the tune of 2 million barrels a day, roughly 2%. That was a lot. So that hangs out there. But, Joe, and I think this is the fundamental backing to what you're saying, when the hostilities cease, there is a lot of infrastructure that needs to be repaired in the Persian Gulf. It is not just simply opening up the taps, filling up the tankers, and shipping them out. That process, by the way, takes weeks. You can't just, flood hundreds of tankers through the Strait of Hormuz.
Yeah, sure. The market's going to move dramatically, though, anyway, on the headline, long before, like it does everything else.
As it is right now. Yeah. But the point being is there is a fundamentally structural reason to think that oil and gas companies in particular are going to do well here. A lot of, in particular, liquefied natural gas infrastructure has been damaged in the Gulf. That stuff really can't be stored that well. So it's not like you can tap into strategic petroleum reserves.
No, but what about something like Cheniere, for example, which because of the disruption over in the Middle East, the thought was that these guys were going to eat up every contract imaginable for the foreseeable future. And if you look at what the stock has done, it's up 20% just over the last month. I think you own that.
I own it. I love it. Now, if we take a much longer chart, like take a 5-year chart, this stock's been just a war horse, okay? And I think, by the way, even with the rise that you see over the last 5 years and in the last few months, I think this stock is going higher. Here's why. They are putting more and more export trains into construction on the Gulf Coast. The U.S. is going to increase its already sizable export capacity of natural gas. We have so much natural gas here in the U.S., we flare it off. If you're in the Netherlands, if you're in Japan, Korea, you desperately want that natural gas. You're looking at us flaring it off and saying, stop, hold it, get these export trains from Cheniere in place.
The pioneers really in the exportation of liquid natural gas.
Yes.
Cheniere. Which, by the way, gets upgraded today. Overweight from equal target to 313 from 236. 313 from 236 was like yesterday, right, in this one. So Morgan Stanley still likes it like you do.
This is not a flash in the pan is what I'm trying to say. Some people may be looking and saying, okay, well, when the Gulf hostilities stop, Cheniere will plummet. Now, listen, Gulf hostilities stop, it probably will come down a little bit. But for the next several years, as it just continues to expand, and honestly, who's really going to want to buy from the Persian Gulf in the same size that they did before this conflict? This conflict is going to have lasting repercussions. Countries, sovereign entities are going to redefine their supply chains for this critical commodity, liquefied natural gas, and the Gulf Coast of America is an attractive place from which to obtain it.
I don't think it's a bad problem to be trimming into strength. I mean, I've been trimming SLB into strength because 34% of their revenues comes from the Middle East.
You mean you'd be trimming some of these names in energy that have run up a lot?
Absolutely. Absolutely. I love the story long term. I'm just trimming it back, but it's up 30%. It's not as cheap as it once was, and I do think you're going to have bottlenecks, big bottlenecks in the Middle East after all of this. And that was the story for SLB, that you would see the Middle East see the recovery growing from nothing to up 6%.
But some things like the Chenieres of the world, like if you have taken out the infrastructure to allow the delivery of natural gas in parts of the Middle East, and then you have a company like that, which they suggest is so bullish for their contract. Now that's different. Jimmy's not looking to trim into the strength
long term.
And these others are suggestive that there's a lot more strength coming.
I mean, I think there is going to be a lot more strength coming, but I think they could sit here for a while and they may underperform for a while because they've done so well.
But they're not all
so
created
many
equal.
unknowns.
I guess that's partly my point.
That's a good
too.
point.
It
That's
is,
an
it's
excellent
true.
point.
But I do think you do want to trim some of the energy stocks. They've had a nice run and look to be buying, buy low, sell high. That's all it is. Look
Buy
for
high,
other
sell
prices.
higher. What do you didn't you read his book?
I'm not in. No, I know. I mean, I did read your book, but I'm not.
All right, don't say anything. I don't want him to get upset. Bryn, Bryn, your play here is what? You own Diamondback, you own Viper, and obviously you have thoughts on the entire space. You own the XOP.
Yeah, let's talk about the XOP. I think where you look at the rig count, I didn't look at it today, but let's say before Iran, there was about 550. The last I looked, there was 554. So the rig count really hasn't moved higher, which to me says, especially like on the XOP, the exploration and production, they are not being incentivized to drill more. What they have been incentivized to do is to have capital discipline, buy their shares back. And so if we have elevated prices here for multiple quarters, a lot of that goes to the bottom line of these companies. And so we still really like the mineral right names, which are very sensitive to the price of oil, as well as the exploration and production, as they keep that capital discipline, because you're not seeing us going to be producing more, because I think they're all suspect of how long these higher prices last, looking at the futures curve of oil.
So to your point, I think when you look at the energy trade, I'm going to respectfully disagree with Stephanie on Schlumberger because
Is that because she said something about your book?
No, it's because if you
if she said I love the title of that book and the thesis, you'd be agreeing.
I would still disagree.
I love the title of the book. I
We
just don't
own
agree with it.
Schlumberger, we own Baker Hughes in the ETF, and what's interesting about both oil field services, they both peaked on the very first day of trading after the conflict began. The high for Schlumberger was 52 on March 2nd. It actually declined down to 44. Oil field services have come under pressure the entire month as the strait has been closed. So I think right now what you're seeing is a little bit of transfer in terms of positioning away from what I've talked about on the network was let's go own Suncor, let's go own Canadian Natural Resources, let's own Petrobras as alternative sources of production. Let's now go back on the expectation de-escalation that the oil field services names like Baker Hughes and Schlumberger and the OIH can work once again.
But Schlumberger has gone from 11 times earnings to 17.5 times earnings, which is not expensive relative to the market, but it's expensive relative to Schlumberger. And when you have a third of their business now is going to be under fire, I think, and it's going to take a long time to see a recovery. Maybe it'll be pent-up demand. Maybe we will see it in a year from now. But the story was for this year, Middle East to recover. And I don't see how you're going to get that done, not for this company, and especially since it's had such a nice run.
I think the entire world has very strong motivation right now to do all they can do to spend, to increase production, and I think that benefits someone like Schlumberger.
So chip names are up a bunch today too. They've been caught up in this whole thing as well with the oil spike. If oil goes up, energy costs go up. It takes a lot of energy to run those data centers, doesn't it? Chip equipment names: KLA, Lam, AMAT, all higher. Those chip charts look awfully similar today. You're looking at about 2% gains across the board. AMD is having talks with a Korean startup for 10,000 AI processors. That stock looked pretty good earlier. Come back a little bit off the best levels, but it's still good for about 1%. And how about our call of the day? It's a big one today, too. We didn't get to it for 20 minutes because there were just, frankly, more important things to the overall market to discuss. Microsoft, okay? The target cut by $30. That in and of itself, okay, that's not that big of a deal, right? To 400 from 430. It's at Melius. It's from Ben Reitzes, who says somebody has to say it. Microsoft's issues are mounting. The bulls say Microsoft is time to eventually get AI right, even if it messes up the first few times, as has happened before. Sorry, but AI waits for no one. As our clients evaluate which Mag 7 stocks to sell to make room for Anthropic, OpenAI, and SpaceX into 2027, right? Get that? You can't own everything, and these companies want to go public either sometime this year or perhaps into next. You got to have room for it. He says, Ben does, Microsoft could be a source of cash. Bryn, you get that one first. Somebody has to say it. Microsoft's issues are mounting. What do you think?
I think he's kind of spot on. I mean, I don't think you have Mustafa running the AI group anymore. Copilot, just like Teams, is terrible. Now they're using Anthropic to have co-work, which is Anthropic. So to his point, Anthropic is continuing to build itself into enterprise, even with Microsoft. The stock's traded terrible, and so I think he's kind of spot on. I'm frustrated with their execution. Okay, the stock prices is down, but I am very frustrated with the execution and the lack of. I use Copilot. We have it at work for enterprise, and I don't use it because it's clunky. And so I think just like Teams, I never use Teams. I use Zoom. This is where can a big company actually execute versus a small, more nimble company like an Anthropic or a SpaceX or OpenAI. Big, I mean, little, smaller. So I think it's a pretty good note that investors have to take note of and bake that into their forward-looking projections.
What do you think of this call today?
I think he's correct to say someone had to actually say it. If you look at the analyst community right now, you have 94% with a buy rating, and the 12-month price target is 596. Bryn's spot on. I don't believe that Copilot is incredibly efficient. Before the show, I was talking to our executive producer, Kevin, about my usage of Claude Max. I think it's efficient.
I already dropped his name on the show like twice earlier. That's enough.
Well, I just dropped it again.
That's enough.
But anyway.
Now you're pandering to the EP.
Copilot is not efficient for what I am trying to accomplish within the market. When you think about it, they launched it in February of 2023. Now they're realigning the divisions so the commercial and consumer divisions will begin to work together. And then you have to go back and look at the growth of cloud. And in the most recent quarter, there was stagnation in that growth. It came in at 38%, but yet we're going to spend more. We're going to go spend $37 billion more. Jimmy, I own Microsoft. I'm with you. It's not. Okay. I want them to succeed, but you have to acknowledge they're in a little bit of an environment right now where you're questioning where they are in AI relative to some of their peers, and they're also being punished for the open AI relationship without question.
Okay, so the reason my jaw dropped when you said that is because to me, where the stock really picked up steam to the negative side was the last earnings report. That's where the sentiment changed, and it was because of exactly what you said, the 38% growth rate in Azure and cloud services. Now, first off, I want to just say 38%, we're really going to sneeze at that? I mean, it's a rhetorical question. I'm not. But also remember that they were supply chain constrained, and they probably could have hit the 41% whisper number, and I think probably will in the quarters to come. It has become a battleground stock, in my opinion, less so because of the OpenAI relationship and Copilot, and more so because of that cloud services business growth, which still at 38%. I'm sort of scratching my head that we hate the stock, but it's going to be a battleground stock until we see those Azure numbers continue to pick up, which I think they will.
All right. Let's take a break. Should we do that? Why don't we check the markets as we go out as well? So we're off the best levels of the session, but nonetheless, we're green across the board. The president says we had talks with the Iranians. They say we didn't. We're going with our president, who said we did, and the stock market is obviously reacting in kind to that. Russell's leading the way, 2 1/3%. We're back after this. Most of us are back. You back? Back. Most of us are back. Just let us. Were you settled? Now
I'm good.
We're good. All right.
I'm good.
All right. Don't
you
worry.
had nothing to do with it, though.
Don't worry.
Right?
Don't worry. You're sweating a little bit. Don't worry.
No,
But
I'm
it's
not
all
sweating,
good.
but I was.
It's
you
all
know,
good.
I had to bail my friend out.
All right. Let's start with Stephanie Link and a move.
Yeah.
That she has, because the financials are having their worst month since December of 24. Still the worst sector year to date. Whether it's worries about the economy, the war, private credit, rate hikes, you name it, the stock's not traded well.
No.
Obviously. You're buying more Truist.
Yeah.
Why?
And it is down 8% on the year. It has lagged the other regionals as well. I think this company is really doing some great things from their new management team and their new strategy to grow profitability, 15% this year, 16% next year. That's the ROTCE that we talk about all the time. But last week we got GSIB rules and Basel III endgame rules. These are regulations, right? And so we're starting to see the deregulation kicking in. I think as a result, you're going to see the banks at large really start to increase their buybacks and dividends. Overall, the big six have $176 billion in excess capital. I think it's going to go to about $220 after all these rules. So more buybacks, more dividends, more lending, which is a good thing. And Truist will benefit as well. It's trading at 0.9 times book. Historically, that's when you want to buy a bank under book value. It's very accretive. And by the way, this company already has a huge buyback in place at $11.5 billion. That's 20% of their market cap. So just imagine these new rules will give them even more flexibility to continue to show their shareholder value and appreciation.
What do you think of this move in the regionals by Steph? Well, which you own, you still have a fair amount of exposure.
We have a fair amount of exposure, and in full disclosure, it's hurting us so far in the current quarter. The significant exposure we have to the financial sector is one of the reasons why I look at the strategy and I see a degree of relative underperformance. So I will say this about the regionals, and I like Stephanie's move. I do think there's a degree of resiliency specifically in the regionals. Really, when you look at the financial sector, the significant troubles resides itself in a lot of these private equity names, and to a certain extent, some of the money center banks, which are giving back significantly strong outperformance from 25.
Jimmy?
I like the move. I think the financials have been unfairly tarnished by a number of things, many things, and we've gone through them. Private credit, concerns about a recession, and the capital rules that you're talking about, Steph, are going to inure to the benefit of everyone, whether it's regionals or big money center banks. We know that the IPO market and capital markets have been a little bit frozen because of what's going on in Iran. Again, if we think that history is rhyming and that the hostilities are going to decline, then the spring and summer could be a very good time for the capital markets. I see a lot of good valuations across the spectrum, whether it's money centers or regionals. I like this move a lot.
Let's do some calls of the day. You guys see that story today about a bipartisan bill to ban sports from prediction markets? I thought it was interesting. Obviously, we have a commercial relationship with Kalshi, but this is pretty significant, and it's having an impact on the casino stocks. Take a look at some of these names. Wynn, LVS, that's in our orbit, obviously. Steph owns LVS, Jimmy owns Wynn. What do you think, you guys, of these? Steph, you first. This headline that you have this bipartisan bill, just a bill. I don't know where it goes from here, right. But you got a pretty significant, obviously, casino lobby.
But it makes me feel good to own LVS because they don't have any U.S. exposure, right? They're about 60% of their business is Macau, 40% Singapore. They're humming. But I do think it will have an impact on the overall group. I think it will have an impact on Wynn, but I think it'll be manageable. And that's, again, if it even goes through. There's a lot of questions still.
I think the bigger reason for the stocks to be up today is the cessation or the reduction potentially in hostilities. But I think this bill does help. I think it's a reasonable question to ask: is why are the sports books of the casinos regulated differently than Kalshi or Poly markets? I think it's a similar question to why the banks are saying, with regards to the bill that's working its way on crypto through Congress, how come the crypto companies can give interest and not be as regulated as we do? What I think this ends up with is that these prediction market companies are regulated a little more than they are now. It's somewhere in the middle. I'm not sure that this is going to move the needle that much for the casinos, but again, the casinos have so much more, and the reduction in hostilities matters much more.
I'm guessing that you get the DraftKings got to be up on this too, right? And the other ones, can we look at that? How could it not be? I mean, I think there was already a developing battle between the traditional online, sports gamers and the prediction markets, right?
Yeah, there was, and I think Jimmy's right here. I think really the change is going to occur not so much for the actual casinos themselves, but in the prediction markets. There needs to be some standards that are put in place moving forward. I like that strategy. I'm aligned here with Steph. Jimmy, you know this. We took our first position in a casino in October. We did it in Las Vegas Sands, and it really was on the strength of the balance sheet relative to a name like Wynn.
All right, Angelica Peebles has the headlines for us today. Hi there.
Hey, Scott, flights were briefly halted this morning at Newark's Liberty International Airport due to a burning smell in the primary air traffic control tower. According to a Port Authority statement, staff were able to temporarily relocate to a backup tower, and the ground stop was lifted after about 30 minutes, and it's not immediately clear what caused that issue. House Democrats launched a new inquiry into outgoing Homeland Security Secretary Kristi Noem's top aide, Corey Lewandowski. It follows an NBC News investigation alleging he sought personal payments from contractors, including private prison company GEO Group. Democrats asked the company to disclose details of meetings and conversations it had with Lewandowski. Meta CEO Mark Zuckerberg is reportedly building a personal AI agent to help him lead the company. The Wall Street Journal reports it's helping him get information faster by retrieving answers that he would typically have to go through layers of people to get. And this comes amid a push at the company to reduce internal bureaucracy and compete with AI startups with smaller staffs. Wouldn't it be great if we could all have an AI assistant, Scott? Back over to you.
Yeah, we probably will at some point. Angelica, thank you. Angelica Peebles coming up. Your ETF Edge, Dom Chu has that. What do you have on tap today, Dom?
All right, so Scott, long have hedge fund managers used computer models to try to identify trends. We're going to talk to an ETF manager that's replicating some of those trend-following devices coming up on the halftime report. Keep it right here. And welcome back to the ETF Edge portion of the halftime report. When volatility strikes, it can cut both ways if you're not prepared for surprise moves like today's. So what if you could replicate a hedge fund-like strategy without the hedge fund costs? certain ETFs may offer a solution. Joining us now to make that case is Andrew Beer, founding and managing member at Dynamic Beta Investments, or DBI as it's known in the street. So thank you very much, Andrew, for joining us here. Let's start with a very broad question that kind of gets at the heart of what we're trying to talk about here. Has the market action that you've seen over the last several weeks and quarters, even at this point, been characterized as normal in your mind, the volatility that we've seen across all asset classes?
You're absolutely right. What we're seeing in the markets right now is not normal, right? Oil should not go up or down 10% in a day. We should not open, as we talked about, up 1,000 points and be back up 600 a few hours later. What the market is signaling is that the crystal ball is broken, right? And the world could be fine in a year, or it could be very, very bad in a year. So I think what the market is telling you right now is it is time to hope for the best, but prepare for the worst.
How exactly then do you prepare for the worst? We've talked about diversification broadly, go into all these different asset classes, but you basically run what's called a managed futures strategy in an ETF format. What exactly then goes into managing around risk with futures in trend following, the likes of which hedge funds normally do?
Sure. So what we basically found is a way to take a very, very valuable hedge fund strategy and make it better by being more efficient and then making it work in an ETF. All they do is seek to identify big, major trends and be early, contrarian, and right. It doesn't matter. The terminology doesn't matter. The impact and what it does on your portfolio is what matters. And so part of what we have tried to do is bring that to a broader audience and be able to show that even in these very, very chaotic times, you can find a strategy that thrives on chaos and bring that to a broader group of investors.
And what kinds of things have you seen? Because these are kind of trend-following, computer-based models. What types of investments have you been kind of leaning a little bit more into or away from because of those trends that are starting to materialize in the markets, or maybe a divergence thereof?
Absolutely. So the trends as they are will change over time. The macro themes will change over time, but it was being early and right in gold, buying gold below 3,000 and riding it up. It was this rotation out of U.S. equities into non-U.S. equities as concern grew about the dollar and the U.S. versus international assets. Recently, it's been going long crude oil. So it's always a series of big macro themes that if the world changes in a meaningful way, you'll have an opportunity to benefit from it.
All right, so this is a big conversation, one that we can't do here on television, but we're going to continue this conversation over at etfedge.cnbc.com. Andrew's going to be joined by Nate Geraci, the president of Nova Diaz Wealth. Back to you, Scott. Again, a lot of big conversations here about trends and how to identify them.
All right, good stuff, Dom. Thank you. That's the Domino Dom Chu. Still ahead, going global, the strong year for international stocks. Well, is it over before it started? We will answer that question next. a lot of talk about international markets, and the Wall Street Journal out with a headline today: the banner year for international stocks is stalled before it even began. So year to date, let's just take the EEM, which you see on your screen, is now up 4%. The S&P is down 3-ish, right? Month to date, the EEM is down 8%. The S&P is down 3.5%. Steph, do you agree with that headline? Has the banner year stalled before it even began? Does this change your view at all, this war and the ramifications around the world?
I worry a lot about Europe for obvious reasons because of their energy dependence, rather. But I like other parts of the world that have actually held up remarkably well. I own Brazil, the EWZ. It's up 15% year to date. It's the 7th largest country in the world, and most people think it's a commodity country only, but they have been building up substantially in fintech, and guess what they have that everybody else wants? Power. So they will benefit from the whole AI, data center, grid power themes that we've been talking about for years. They have 214 million people in this country. As I said, 7th largest and the largest in Latin America, and I like what they're doing fiscally and monetarily. So I'm careful on a couple of places. Brazil's my favorite. India has really lagged. I still like India too. So I think there are places that you can invest, Scott, but there's certainly ones that I would avoid.
What do you think, Joe?
I think that
it's a game changer.
No, I actually think it's an opportunity, in particular for South Korea. EWY is the ETF. I think that's a name you want to own, given the correlation and exposure that they have to the growth of AI. EIS, Israel, was a name I was looking to get back into. I did that at the early days of March when the conflict began. So lower dollar, I think central bank policy that still leans towards easier monetary policy. I think exposure to developed international EM, you take advantage of this correction.
Bryn, how do you see this here?
Yeah, I think you want to be specific. So EEM, 20% of EEM is roughly Alibaba, Taiwan Semi, and Samsung. So just know that. I like Joe's point, and I've been talking about this with South Korea. If you want to own memory, SK Hynix and Samsung are 45% of the index. And so if you are long-term bullish on that sector, this is a very good way to own that and have diversification from a Micron or a SanDisk here. And so I think you really have to understand the constituents overseas because you have some extreme concentration within these country ETFs.
All right, we're going to have to wait a little bit, I think, to really find out if this is a game-changing move or at least a months-long underperformance of some of these overseas markets relative to the U.S. But we'll just wait and see. Mike Santoli, he joins us next with his midday word. We're back right after this. senior markets commentator, Overtime co-anchor Michael Santoli is here at the desk for his midday word. We knew we were getting pretty oversold in certain areas, and we knew we were hanging on anything coming out of the weekend. And we got it pre-market.
We were. We got a lot of it pre-market. And, you know, it's really fascinating because almost all the indicators right before we got, you know, the post from the president were saying almost there, maybe not quite, not unequivocally a washout number. You can't just sort of close your eyes and buy regardless of the headlines. But obviously primed enough for a bounce that we got a pretty good excuse for it. And I grant that nobody really knows what to make of the longer term outlook here, whether there's credibility to the claims and counterclaims and how this does end up. But I do think you have to respect and appreciate the signal value of the president indicating something like this is underway. And the market understands that, right? So the market understands that that's a change. We know the window is closing, so this can remain somewhat contained, and everybody knows that. So I think you sort of have to, first of all, we're up more than 2% from the pre-market lows in the S&P 500. It's not nothing. But you came in, to your point, with a lot to prove. It's a 4% pop just to get back up to prove it's not a dead cat bounce. We're not at the 200-day. So it's going to be this kind of trade. But I think you did enough on the downside to say, let's be sure that we're not going to, you know, get caught flat-footed if, in fact, you have an unexpected outbreak of certainty. And that's kind of the tariff playbook.
Well, yeah, well, that's exactly how we started the show, right? The market has seen this movie before. And it forgets that every now and again.
Yeah. Well, here's the thing. It does forget it, ultimately, at the extremes. But I think it was trying to keep it in mind for 2 to 3 weeks, right? That's why it was this grudging decline. I think that a little bit of the cautionary piece of it is March this year, March of last year. When we thought we had to price in a tariff situation, we didn't know how much, and we thought we could kind of trade around it. Maybe we got down 10% before we got Liberation Day, and then the realities of the Liberation Day proposals were kind of so off the chain that the market just couldn't handle it. So do we need something further to the downside and more of a liquidation like we got last year?
Yeah.
I don't think you have to. Nothing says you have to follow that script. But it is interesting how, you know, February peak last year, February peak this year, a lot of the things sort of rhyme.
Well, because those numbers of Liberation Day were so large, they had a dramatic prospect of upending the whole global economy. Yeah. I'm not saying this doesn't, but this can reverse itself in ways that potentially those big tariff numbers.
I mean, I think it could mitigate itself. I mean, I don't know how many barrels you can lose every day. And all the rest.
Mitigate's a way better word.
But I think it could get to a point where the market will have an ability to look beyond it. Yeah. That's the key. And because don't underestimate the market's, you know, tendency sometimes to just consider something settled, even if it doesn't feel settled.
Yeah. All right. Good stuff. I'll see you in a little bit. All right. That's Mike Santoli. We'll do finals next. We catch up today with Jeffrey Gundlach of Double Line. We'll get his first commentary post-Fed. He's had a few days to let everything marinate now, so I can't wait to have this conversation with Jeffrey. We'll do that at 3 o'clock Eastern time on the closing bell. Bryn, what's your final trade?
Zoom. I like the technicals here. It could break out and go to $86.
All right. Jimmy.
Oracle. I think OpenAI is good for enough of the money they've committed that this stock is undervalued right now.
You want to say to everybody what you said to him in the break?
Yeah, I would not own Oracle. How's that? That was nice.
Well, that wasn't exactly what you said. What's your pick?
I was
What's your
wondering
pick?
why you still owned Adobe. So,
What's your pick?
My pick is Dick's.
Okay, Dick's Sporting Goods. And Joey?
Freeport McMoran.
All right, good stuff. I'll see you on closing bell.
Thank you very much, Scott. And we are well off session highs, but still up considerably this hour. Welcome to The Exchange. I'm Kelly Evans. Some euphoric action this morning after President Trump signaled tensions with Iran are easing. The Dow was up as much as 1,000 points. We're now up about 654. And keep in mind, both the Dow and the small caps had entered correction territory after last week's sell-off. The Fed, a big problem for the small cap Russell 2000. We'll get to that later on. But look, right now, they are leading the way, regaining their mojo with about a 2.4% pop. The S&P and NASDAQ both up 1.2 to 1.3%. And after briefly spiking to $100 earlier, WTI crude is now down sharply after the president's 5-day postponement of strikes on Iranian energy sites. You can see Brent is at 100, well off its session highs from earlier on as well. But remember, Brent will continue to influence our gasoline prices, which continue to rise even while crude is falling. Similar story in yields. Just want to briefly show you the 10-year going from a high of 4.44 today all the way back down to 4.3% before settling in the middle. And the 2-year, talk about volatility here. It briefly touched 4% earlier on. That was the highest level since last June. That also has to do with shifting odds of a Fed hike. Yes, a hike. It's down at about 386 right now. But let's begin with the latest developments on the Iran war, which has contributed to all of this gyrating market action. Eamon Javers is live in Washington. Eamon, with what we know at this hour.
Kelly, that's right. President Trump told reporters today that his administration is in contact with Iranians who he said are very representative of the country in talks that went late into Sunday evening, he said. And as a result, he is suspending his own deadline of today for the bombing of Iranian power plants, offering a 5-day extension on that deadline. And he said he's considering a post-war power sharing arrangement of some kind with the new Iranian government for sea traffic through the Strait of Hormuz. Here's what he said.
That'll be opened very soon if this works.
How soon? And who's in control of it? Will Iran still be able to control the flow of oil?
Be jointly controlled.
By who?
Maybe me. Maybe me.
You want the United States to be in
Me
control
and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. Look, and there'll also be a form of a very serious form of a regime change. Now, in all fairness, everybody's been killed from the regime. They're really starting off. There's automatically a regime change.
But in response to the president's early morning post on social media, Iranian state media put out a statement saying that there have been no negotiations and describing President Trump's extension of that bombing deadline as President Trump simply backing down. Now, the president, again, in his comments today, cited the Venezuela model for post-war governance of Iran, saying he's dealing with people that he finds to be very reasonable and very solid. He said the U.S. may be able to find a leadership figure there to deal with, and he again predicted that when the conflict ends, the price of oil will drop like a rock, but cautioned that he couldn't guarantee anything. Kelly, back over to you.
All right, Eamon, appreciate it very much for now, Eamon Javers. Let's talk more about this reversal by the president and how likely it is that talks are in fact happening, which was something Iran was reportedly calling fake news. Joining us now is Jonathan Panikoff. He's director of the Snowcroft Middle East Security Initiative at the Atlantic Council. Jonathan, good to see you again. Just jump in here, and what do you think is the state of affairs diplomatically between the U.S. and Iran?
Yeah, thanks for having me. Look, I think clearly there's been some movement. We saw this behind the scenes. This rumor now that the Pakistanis are offering to host an engagement negotiation puts a new player in the mix here. The reality is the Omanis are not going to be a trusted mediator anymore. The Qataris are taking direct hits, and so it makes it awkward. And so the Pakistanis, maybe the Turks are slightly stepping up here. But we're still a long way from this crisis being resolved. President Trump's decision is a 5-day extension on some of the infrastructure. It's not a permanent one that we're not going to hit the infrastructure or that the Israelis may not. So we've got some time to go, but clearly there's been some progress, and that's obviously helping, especially on the markets and the energy sector.
Do you think the U.S. and Israel are on the same page with all of this?
The U.S. and the Israelis both still have target lists that they really want to complete. You're talking about another 2 to 3 weeks really worth of targets that they want to hit. So if we got through most of it, do I think the Israelis would sign off? I think they probably don't have a choice. At the end of the day, the U.S. is going to make a decision to end this conflict either through a negotiated settlement or unilaterally. I think the Israelis maybe can strike for 24 hours after that, but they're going to probably go along with it. The question really is on the other side. Do the Iranians go along? We've seen significant challenges about what political figures in Iran are saying may not always match what the guards want, those that are actually controlling the war.
You know, there was an interesting note from Ed Yardeni, a longtime markets observer here. And he said the odds of a longer war are increasing, even as Trump is set to declare victory, which I thought was an interesting point. I think we all sense this as well, and to quote him, he said, is the fog of war thinning or thickening? The president says he's ready to declare victory, but the Iranians have been at war with the U.S. and Israel for 47 years and are showing no signs of ending it. He adds, the president seems to prefer a unilateral conclusion where the U.S. stops because it has, quote unquote, won, rather than a negotiated truce.
I think that's absolutely right. Look, the 47-year point is very, very important. And now you've got a 47-year history with a regime that's frankly more hardline than what preceded it before the war began. And so I think that's going to cause a lot of questions about, do you have a meaningful truce, or you just have the president having to unilaterally declare victory, even if the on-the-ground facts don't reflect it. At the end of the day, I think the real concern and why you're seeing even a lot of Gulf states saying, no, U.S. and Israel continue and finish the target list is because they don't want to be in a position where the Iranians have so much leverage, frankly, and have actually increased their deterrence capacity beyond what it was when the war started. And right now, if you look at the Strait, that does seem to be where it's heading. Doesn't mean it's going to have to stay in that trajectory, but that is the current one.
Yeah, and over at the Wall Street Journal, Shelby Holliday had reported that it was actually significant that the Iranians launched those missile strikes at Diego Garcia. They missed, but the point was, I guess in the past they had said, our missiles are only really capable of reaching Israel. And now they've shown not only can they go, I guess, twice as far, but that puts Europe in play, that puts Africa in play. And so the threat all of a sudden to those regions is larger than it was before. Do you think this is all just show, or is there some truth to that?
No, I think there's some truth to that because, again, you're going into a regime that's fundamentally different. One thing that probably hasn't gotten enough attention is actually, it wasn't that the Iranians couldn't hit that far, it was that there was a fatwa by the Ayatollah Ali Khamenei that was taken off probably after the June war in terms of what the distance would be and how far they would fire. Now, clearly, they have shown that they can fire much further. They can hit the 4,000-kilometer range, maybe more. That's putting all of Europe at risk, and I think that the Iranians want that because, again, anything that increases their power projections and their deterrence, even if at the end of the day they're significantly diminished in their ballistic missiles and their nuclear capabilities and their proxies, the knowledge doesn't go away. And so they're going to be hopeful that they can eventually rebuild. That's going to be buttressed against almost an Israeli guarantee, frankly, that they're going to go to a mow the grass strategy long term. And so then it's this question of, even if you get to an off-ramp now in the next, say, month here, do you have cycles of violence every 6 months to a year? What does that look like? It's going to keep the Gulf energy markets, frankly, all of the global supply chain on edge in a way that we really haven't seen. It's going to be a new Gulf, frankly, going forward.
And finally, if you could just kind of elaborate on that, because from the market's point of view, the only thing it can really discount is maybe a little bit higher oil premium, maybe, the defense trade. It's going to look for vectors of immediate impact as opposed to what you've said, which, while important, is almost impossible for it to kind of bring into consideration. So what might that permanent change look like? And is there any other place where you'd see, quote unquote, the rubber hitting the road?
Yeah, I mean, look, I think you're going to see it across sectors, frankly. You'll see it across, obviously, the energy sector. You're going to see it across the petrochemical sector. I think one of the questions that's really going to be interesting going forward is whether or not some alternative routes start to happen. In other words, there's been this long idea that started in the Biden administration of IMEC, to have basically what amounts to a north-south corridor, something to be able to avoid the Strait, for instance. Do those types of efforts actually get sped up in a way that really was not going to be on the front burner, and now you have Gulf states, the Europeans, and the U.S. all saying we have to look for other avenues for the supply chains to be able to demonstrate resiliency in a way that right now they're going to be under threat. So I think, yes, there's going to be huge hits, frankly, across sectors, possibly long term, but there are also silver linings and opportunities that may come out of this, and different avenues for global supply chains may be one of them.
I've been wondering about that, how much can literally just be shifted away from the region if it remains problematic. Jonathan, thanks for now. We appreciate it.
Thank you.
Jonathan Panikoff from the Atlantic Council. As you mentioned, stocks are off session highs, but up nicely across the board, up 1.5% for the Dow. Our next guest says the bull market remains intact, and interestingly, says U.S. stocks will be the place to be. Joining us is Caterina Simonetti, Executive Director at Morgan Stanley Private Wealth Management. Caterina, I only say that because others, like Yardeni, not to cite them again, say their preference for going international will resume once the conflict ends. But you're saying that you think U.S. stocks will still be the most attractive?
Well, Kelly, thank you for having me on the show. Of course, in any type of situation like this, when we look at the military conflict, it is difficult to make any kind of calls because this is one of the highest of the systemic risks, this unpredictable risks that we have seen. But our call absolutely is on the U.S. large caps, because in the time of this uncertainty, two things have to happen. One is we have to focus on quality. We have to stay with quality companies that have predictable cash flows and are able to absorb the higher costs that might come with higher oil prices. And then the second part of course, is the fact that we've seen valuations come down significantly. In fact, since last October, the stocks of S&P, 40% of S&P stocks are down more than 20%. So this presents buying opportunity in high quality companies here in the U.S.
Okay, so while that's taking place, Caterina, more generally, we just had this conversation about what might be going on for months, really, in this conflict. As much as the president might say, and perhaps the acute phase of it is winding down, there's going to be these longer-standing reverberations, I guess you could say, in energy markets. Does that have a bigger impact here on either the odds of a recession or inflation, on what the Fed will do? And, you say the bull market remains intact.
Well, the market, of course, does what it does. The markets tend to price in the end of the military conflict significantly before they happen. War in Ukraine, for example, is still going on, and yet 4 years later, the market is significantly higher than it has been because of the AI expansion, because of the earnings momentum, because of the low inflation. So we have to look at it as a whole, and the risk of the recession still remains significantly high. So as tempting as it might be to see this current correction in a very similar light as what we've seen a year ago in the Liberation Day is very much a very different situation. And we do see the oil price as a big component there, but we also expect it not to be quite at $100, and if it gets there, not to stay there for long.
Yeah, I thought it was interesting that we've seen earnings estimates, not just for the full year, but even for the quarter. Those have been on the rise even as the war broke out.
Correct.
I mean, that tells you that as much as we might be seeing a little bit higher odds of recession, a little bit higher odds of Fed rate hikes, the earnings power that we've seen, I guess, would you say that's what kind of gives you comfort? Do you see any deterioration further down in the year because of what's happened, or no?
Kelly, that's exactly it. The strength of the AI momentum and the expansion of earnings, specifically here in the U.S., is cannot be disregarded despite of what's happening in the world. With that, we must proceed cautiously. This is where quality might be considered, sector exposure must be considered, and the concentration has to be on areas like industrials, where there's still that AI buildup and expansion. Healthcare, for example, is another area where we see tremendous buying opportunities, materials, and of course, energy. when we are talking about energy, we must be buying energy, and we must be doing it carefully and positioning the portfolios to take advantage of the move that is happening in the sector because of what's happening in the world.
I mean, it's pretty interesting. You have the broad markets down 7% from the highs, but energy's up 32% this year. And we could all wake up tomorrow and to a totally different set of circumstances until this feels like it's really winding down. So would you tell people, there's a big debate. I mean, a lot of people would say book your gains in the energy space and walk away. But you sound like you're saying, no, you need to have maybe more exposure here.
There's time and a place for booking the gains. For example, our call last year was small caps. We increased the exposure, we made significant progress there, and now we're scaling back. We're scaling into the large caps. Same goes for energy. Energy is here to stay. It's essential, it's important for profitability for the companies. We are not going to get away from it. Now, of course, the price of energy, it matters. And can we expect a pull back in some of the earnings and some of the gains that we're seeing right now? Absolutely. And that's why we need to diversify into the other areas that have declined because of the current situation, where we see the buying opportunities without abandoning energy.
Right. All right. Katerina, thanks. Appreciate it for now. Good to see you. Katerina Simonetti of Morgan Stanley. Coming up, are rate hikes now on the table? Carl Weinberg from High Frequency Economics thought the Fed might even hike last week. He'll be joining us to discuss what markets should be prepared for. But first on CNBC interview with NRG Energy's chair and CEO, live from CERAWeek down in Houston. After a massive run-up in the past year, the shares are actually having their worst month in more than 3 years. We'll talk about why they're down 15% since the Iran war began. Next.
This is The Exchange on CNBC.
Welcome back and take a look across markets. Dow's up 617 at the session highs. We are up 1,000. Small caps are leading the way, but they've had a tough recent time since the war. Not just the war broke out, really, but we've started seeing more odds of a Fed rate hike. We'll talk more about that a little later on. Norwegian is leading the S&P as oil prices retreat today, which is helping the cruise lines across the board. Norwegian's up 7.5%, but despite these gains, a lot of these stocks are still down between 10 and 20% this month. Carnival today up 6%, Royal Caribbean up about 4%. And CF Industries, which we've talked about a number of times here, today is giving back some of its gains, and one of the worst performers, down 4% on the S&P after it and the other fertilizer stocks have seen a huge run up this month. They're still waiting to see what the pass-through effect of that will be for crop and food prices. And Synopsys shares are higher on news that activist investor Elliott Management has built a multi-billion-dollar stake in the chip design company. Elliott's managing partner telling CNBC, quote, as AI drives a step change in chip complexity and capital investment, Synopsys is uniquely positioned to benefit from this growth. And the shares are down about 7% to start the year. I understand they may want them to do price hikes, for instance, given their strong market power. Coming up, the next leg of the AI race is here, and it's a bidding war for private equity. OpenAI and Anthropic are competing to push their AI tools into hundreds of companies all at the same time. We'll look at who's winning and who their partners might be next. Welcome back to the exchange. You can see energy prices down sharply today, not just oil, but also nat gas here and in Europe by about 5%. Amidst all of this, our Brian Sullivan finds himself at one of the biggest energy gatherings of the year, the CERAWeek conference down in Houston, Texas. He joins us now along with the CEO of NRG, which is a major U.S. player in electricity and nat gas. Great to get their perspective on all the goings on. Brian, it's good to see you. Take it away.
Thank you very much, Kelly. Good to be seen. Yes, NRG is one of the largest independent power producers in the United States. And we're here now with Larry Coben. He is the CEO, for now, of NRG. He's going to be vacating at the end of April.
Correct.
All right, so we got you here, though, now.
I am here. I'm
so
with you.
So you're still running the company. How hard is it right now to manage a company or run a company when you've got energy prices, not gas, not as much, but energy prices have been as volatile as they are? How difficult is that?
Look, it's always difficult because energy prices are always volatile. This is obviously a very special time. We are less impacted by oil prices, which is where the real volatility has been taking place. Than we're more affected by natural gas prices, which have risen, but it would take a far more protracted war, I think, to impact them dramatically. But obviously, our customers are greatly impacted, and if our customers are impacted, that reflects back on us. Some of the things we do with chips are obviously going to be impacted if oil prices continue to stay up, as they're manufactured in areas that are very oil dependent. So those are probably the two greatest impacts. But in the short term, I think for us, compared to others, not that great.
This may be a stupid question. I apologize. Do you see changes in electricity use based on maybe your customers' view of the economy? What I'm trying to get at is, have you seen any declination of energy or power use as maybe people are cutting back or worried the last few weeks?
Not yet, but we haven't seen a great change in power prices either, and I think it's too early for people to be changing their business models based on a war that's going on for 1 month, other than perhaps the airline industry where your jet fuel prices have increased dramatically. So to date, we haven't seen much difference at all in consumption, and I don't really think that we will for quite some time unless this really sticks as an economic downturn.
Well, thank you for not saying it was a dumb question. How long would it take to know? When would, if things keep going up, let's hope they don't, and they're down today, but if things go back up and stay up, how long would it take to gauge?
My guess would be we wouldn't see much in electricity until Q4, because electricity prices are going to move with natural gas prices. And so the only reason you would have less consumption is if people's overall businesses slow down. Yeah. I think that's going to take a while to iterate into people's thinking and making those kinds of changes.
Let's switch gears I want to talk about data centers.
Sure.
You recently, last earnings call, I think you said 6 gigawatts of power translates to $2.5 billion of free cash flow, something like that?
$2.5 billion of EBITDA, yes.
EBITDA, okay. Yeah. So how much then does the growth path of data centers and AI mean to NRG investors?
Well, obviously that's an enormous amount of money, but I should point out that without any data centers at all and without any price increases at all, we're projecting a 14% increase in EBITDA and EPS. So we're very well positioned, even if there's never another data center in the world. But having said that, I do think that it will be a significant driver. We're seeing substantial amounts of interest from the people who are hyperscalers and others who are building data centers and need to use them. The amount of compute that people need is extraordinary and going up every day. So my prediction is that we will see at least that 6 and maybe more.
Okay, Sam Altman, you might have heard of this guy, OpenAI, obviously.
I've heard of him.
Speaking at a BlackRock conference, I don't know, 2 weeks ago, didn't say he was concerned about spending, but there was some comments that you could imply weren't as confident. Is there anything on your planning that says, well, what if AI isn't what we think it is? What would that mean for you guys if we don't get the growth projections that are currently out there?
We have said very, very clearly that we're not going to build any of that new 6 gigs without a contract with a credit-worthy hyperscaler. So if nothing happens and it all goes away, we still have a 14+% growth rate that we're very happy to fall back on, and we think we can even do better than that, but that's what we've now said to the street is our growth rate. We are not seeing from the big 5 companies any change at all in their capital expenditures. They're all still spending, 9 figures, hundreds of billions of dollars a year. And the only way they can find out if that is a real business is if they build the data centers, buy the power, and run it as a business to see what the ROI is. And that's going to take at least 5 years for them to figure out.
All right, well, we're glad you're here to figure it out in 5 minutes. Larry Coben, CEO of NRG. Really appreciate the conversation. Thank you very much.
Thank you.
And Kelly, I will see you in about 10 minutes, 20 minutes, whatever it is, for Power Lunch. Perfect time, perfect name, perfect place.
Yeah, I thought I saw people maybe grabbing a bite behind you as well. Brian, thanks. We really appreciate it.
Literally, the guy walked like right in. I was like, we're on live TV. Oh, sorry about that. People are on their phones. They're not paying attention.
Look up. No, I do it all the time.
Yeah, I was like, wow, he's kind of close.
Thanks, Lily. And our thanks to Larry Coben as well. Sticking with AI, it's actually the perfect segue to Anthropic and OpenAI, which are in the middle of a high-stakes bidding war with, alongside in involvement with private equity. The winner could end up deciding the future of enterprise software. Mackenzie Sigalos has more in today's Tech Check. Interesting way to try to get their technology in a bunch of hands at the same time, Mac.
Yeah, something that we haven't seen before. And the news today really builds on what we heard last week, that OpenAI and Anthropic are both courting private equity firms as distribution partners, trying to get their AI tools embedded across portfolio companies. But according to a new Reuters report out this morning, it's OpenAI that's offering the more favorable terms. They're dangling early access to new models, along with a guaranteed 17.5% minimum return for PE firms that join its proposed enterprise JV. That is well above a typical preferred return. Reuters reporting the company is in advanced talks with TPG, Bain Capital, Brookfield, and Advent on a $10 billion vehicle, with the firms expected to contribute about $4 billion. Now, OpenAI's Fiji Simo last week called it a deployment arm for their tech. Anthropic's running its own parallel effort, talking to Blackstone and others, but without the same financial sweeteners. And the play here, you said it, Kelly, it's distribution. PE firms sit on trillions of dollars in portfolio company revenue, and once your model is customized and embedded across hundreds of those businesses, it becomes a lot harder to rip it out. That creates the kind of sticky, recurring revenue that public market investors like to see. And the JV structure helps too. Deploying AI into enterprises is expensive upfront, requiring lots of engineering and customization work. By housing that in a separate entity, those costs sit on the JV's books instead of OpenAI, so the parent company's margins look better heading into an IPO. That said, not everyone is sold. Thoma Bravo, for example, passed.
Thoma Bravo passed, but they're the ones who have all the software companies.
Exactly. And so the value proposition here for the PE firms, they're not just writing a check, they're co-owning an entity that absorbs the messiest, most capital-intensive parts of enterprise sales. Then that's why they're getting that guaranteed return. But you had Orlando Bravo weighing in, saying that, portfolio companies are already deploying AI without needing to commit capital through a JV.
Right.
Broader pushback, Kelly, unless you're the lead partner with the board seat, economics hard to justify.
And they're not to say they're under pressure, but of course they have these questions already about their exposure. To software names could be disrupted. So it's a messy time for sure with this innovative solution. Mackenzie, thanks very much. Appreciate it. Mackenzie Sigalos. Coming up, we'll talk about yields, Treasury yields, the 2s and 10s hitting their highest levels since last summer. At the same time, inflation is climbing and consumers are dealing with higher gasoline prices. What does it all mean for Kevin Warsh and the rate cuts he promised to deliver? We'll ask high-frequency economics' Carl Weinberg about that next.
Welcome back to The Exchange. Here is your CNBC News update. Officials in Hawaii are assessing the damage today after the state suffered its worst flooding in more than 20 years. Heavy rain fell over the weekend on ground already saturated by last week's winter storm, forcing thousands to evacuate. More than 200 people were rescued, but no deaths have been reported. Governor Josh Green said the cost of the storm could top $1 billion. Cuba has restored power to nearly half of the capital city, Havana, after its power grid collapsed for the second time in a week on Saturday. Nearly 500,000 homes and businesses were back online by Sunday afternoon, according to Cuba's grid operator. This is the third blackout this month as a U.S. fuel blockade cuts off foreign oil imports. And DoorDash is offering temporary extra compensation to drivers in the U.S. and Canada to help offset rising gas prices from the Iran war. In the U.S., drivers with a DoorDash debit card will earn 10% cash back on gas. And in Canada, drivers can receive up to 36 Canadian dollars per week. The national average gas price jumped 34% in the past month to $3.95. Kelly, back over to you.
Within a hair of $4, even as oil prices drop. Angelica, thanks. And that decline in oil today is also changing the market's Fed calculus, because this morning, before the president struck a more constructive tone on Iran, markets had been pricing in a hike by year end. But that's now changed. Now we're looking at a pause for the full year. The president's statements moving yields around as those odds shift. The 10-year and the 2-year posting their biggest intraday spreads, or swings really, since August of 2025. 21.5 basis points for the 2 years. 14 for the 10-year, which was down at 430 from a high of 444. But my next guest says a hike is still the right call, and even expected one last week, or said it was possible. Let's bring in Carl Weinberg. He's the chief economist at High Frequency Economics, along with CNBC senior economics reporter Steve Leisman. A lot of my macro crowd, Carl, is already jumping to hear you say this. They say you're going to repeat the error of the ECB in 2008 if we do anything like this, and so on. Why do you think a hike might take place here?
Well, you know, oil prices are up substantially year over year. We all know the numbers there, and they vary hour by hour. We saw an $18 spread on oil prices so far today, so I'm not going to pick a point out there, but we're up 30, 40, 50, 60% since the beginning of the year. We're up about 38%, 40% compared to a year ago. These are the kinds of things that generate a 9 or 10% increase in CPI rate of growth, or inflation. And with inflation already above target for years now, and with little sign of underlying inflation really slowing down, the Fed had cause to contemplate hiking rates even before all of this. The higher oil prices make it even more interesting. But before Steve jumps in and asks me a hard question, I'll also add that it's more than just oil that we're talking about here, because fertilizer, 1/3 of the world's supply of urea comes out of the Gulf, and that's not coming out of the Gulf anymore. Helium to make chips, all kinds of inputs to
pharmaceuticals. Yep.
Go
ahead, Steve. Jump in and ask him a hard question.
Well, I want to make an observation first, which is we did have Austin Goolsbee on exclusively this morning, the Chicago Fed president. He talked about this idea of a hike being on the table, so not necessarily disagreeing with Carl. I look at that more, Kelly, as probability guidance rather than forward guidance. In other words, I don't think he's trying to prepare the market for the possibility of a hike, but just saying, look, this is in the realm of possibility. And I think the reason is because, well, they've looked through the tariff inflation. They're running hotter than they want to be running. And the question becomes the extent to which it could spread. And Carl, the question I have for you is, talking this morning with oil expert John Kilduff, and I know you know about commodity markets globally. And so my question becomes this. We keep hearing this thing about April 1, when there could be actual supply shortages. And right now, perceived supply shortages are different from actual ones. How much is it important to you, that you think, for oil prices and the outlook in general, that something be resolved in the next couple of weeks?
So, having never seen anything like this before, but trying to apply what I know about the U.S. oil situation, we have a lot of oil in the United States. We have a lot of oil on reserve in the United States. The world has a lot of oil on reserve. Remember, going into this, the IEA was telling us that supply was exceeding demand, that reserves inventories were higher than they'd ever been before. So we probably have a period of months before we get into physical shortages in most places, but not necessarily in all places. So I think we have to be concerned about physical supply, not quite yet, but we still want to keep an eye on it.
Yeah, Carl, the question I would ask is inflation not I always use the double negative. So just say what I'm saying is, isn't inflation always and everywhere a monetary phenomenon? In other words, in 2022, when we had fiscal and monetary stimulus, we could have high inflation. In 2026, when we have price spikes, which we certainly have and had before the Iran war, aren't they more likely to act as a tax on the consumer? This is the argument a lot of people would make, is that the error would be hiking rates in response to what already amounts to a negative shock on the economy.
Well, there we are. We have a supply shock, and the Fed and nobody really knows what to do about it because we're seeing an increase in prices and we're seeing a drag on growth happen at the same time. And some people remember how Arthur Burns dealt with this back in the 1970s. And he said his declaration, his management of the Fed at the time was that the price shock was something that monetary policy couldn't influence. So therefore, the Fed should do nothing about it and focus all of its attention on protecting employment and the growth rate of the economy. And we know how that worked out. I think everybody on the Federal Reserve is aware of the Arthur Burns story, and everyone on the Federal Reserve is committed to not making the same mistakes today that we made in the 70s. Now, it's not the 70s, all right? We don't have cost of living adjustments to wages that are in excess of 100%. That's a big one that makes it different from then. And to be fair, background inflation was higher going into the oil shock in the 1970s than it is today, and prices were more unstable. Oil just gave it a little push.
We have to go, and Steve and I are both like going crazy because we could need 10 more minutes, but I'll just end with this via Mike Darda, who said the Bernanke, Gertler, Watson research of the late 1990s, Bernanke, okay, showed that the depth and duration of recessions associated with the 1973 and 1979 oil price spikes was mainly due to contractionary monetary policy. The Fed spiked short real rates as the oil shock unfolded. Steve, quick last comment on that.
I would say,
well, that 1996 paper, which I read not too long. Sorry, Carl, I'll just say real quickly, read not too long ago that 1996 paper again, and it doesn't say the Fed shouldn't hike. It said the extent of the hiking is what made it worse. So the Fed needs to respond, needs to keep inflation expectations under control, watch the job market. What Goolsbee said this morning was the idea that he's less concerned about the job market than he is about inflation, and that's an important change in the stance of policy.
And Carl, what were you going to say very quickly?
I was just going to say, we are at full employment. So right now, to worry about the labor market, yes, job creation has slowed, but we don't have any workers to hire. Right. And since we are at full employment, it's a good time to worry about prices at the Fed. All
right. So both of you bringing it back to the labor market it makes sense. That's what we should be watching. Really appreciate it. Thank you for the great discussion. Carl Weinberg and Steve Leisman. Coming up, it's not just energy lower today. Gold is tanking again. Pairing those losses is down as much as 8%, down 3% now, but it's having its worst month since 2011 as the Iran conflict continues. Bank of America says while the recent sell-off makes some sense given its negative correlation to the dollar and rates, they expect a rebound in the near future, even in a, quote, protracted war scenario. We're going to dig more into this next. Gold continuing its slide after its worst week in 15 years last week. Copper reversing course today, now positive, while silver and palladium prices had briefly jumped, but those are now trading somewhat lower. So where is this whole complex headed next? Let's ask Bill Baruch. He's president of Blue Line Capital and a CNBC contributor. First of all, Bill, welcome. Would you paint them with a broad brush, or we saw them all rise together to kick off the year. How would you describe their pattern now?
I think in times like this, where the volatility picks up, you start to see more correlation. And that's what it's been. I mean, you look at gold hit the 200-day moving average overnight. Copper hit the 200-day moving average for the first time late last week. Platinum as well today. So silver has a bit ways to go. I think right now, this run up that we saw in gold, this explosive move earlier this year, silver, gold, copper, a lot of it was pricing in some geopolitical uncertainties. And now we've had this geopolitical event. And what it's created, too, is some selling from central banks of gold because of the oil shock. And it's really going to see how long this oil shock plays out. Though I think there is some tradable lows here that potentially have happened here overnight. It's still, the volatility is going to remain very high.
Where do you expect it to kind of find a resting point? So, and I've heard other theories that, again, going back to kind of foreign markets, and they have to sell gold in order to raise currency to pay for defense in some cases, or oil, as you say. As that continues, where would you expect gold in particular to find a resting point?
Yeah, you're right. A lot of that trade flow that used to settle in U.S. dollar, has also been pushed into gold. Some of that de-dollarization trade. So you can't have both ways. If we're seeing de-dollarization towards gold and you get trade locked up the way it is because it's straight, it's going to create some selling pressures in gold. I like this area we saw against the 200-day moving average, this test overnight. And now when we broke and the selling pressure really kicked in, it was under 4,800. So I think a rebound to 4,800 at minimum is something you want to see. 5,000 would be great. Now, if we start to see the strait clear up and we start to see ships passing and oil comes down, you get the 2-year yield coming off, which hit 5%. And especially right now, you're seeing the CME Fed Watch tool price in a 22% chance that we get 25 basis points hike later by the end of the year, compared to only about a 10% chance of another 25 basis point cut. So, if we start to see some relief on those, I think higher is in the cards, maybe 5,400. And it's easy to forget that right before, the weekend before this Iran conflict began, we had a new high weekly close in gold. So it was knocked off pretty sharply. And it's been some heavy selling in its worst week since, I think, 1983.
Right. But you say, if that starts to change, this passes, oil settles down, maybe the Fed odds change, maybe it can find its footing once again. We'll look for that. Bill, for now, thanks. Appreciate it. Bill Baruch of Blue Line Capital watching that 200-day in gold. Coming up, airlines are surging today as they ride this decline in oil prices. But between oil's recent surge and the ongoing government shutdown, some CEO commentary suggests more problems ahead. We're going to talk about that next on The Exchange. Dow's up 750. Now we have a news alert from Capitol Hill. Emily Wilkins with the details. Emily?
Hey, Kelly. Well, the White House turned down a request from Democrats to meet on funding the Department of Homeland Security, according to a source familiar with those conversations. This all comes as Democrats are continuing to hold out, push for ICE and Customs and Border Patrol to have the same standards as local law enforcement. Pressure's really ramping up on lawmakers to get to an agreement given those longer backups at TSA and airports. And look, they are making progress on areas including limits on where ICE agents can go, identifying officers, among other things. Yet President Trump did seem to throw some cold water on further talks this morning, posting on Truth Social that negotiations with Democrats should stop until they vote on the election reform bill known as the Save America Act. Kelly?
All right, some positive headway in talks to end the shutdown. Emily, thanks. The Trump administration is sending ICE officers to major airports like Newark, JFK, Atlanta, and Chicago to help mitigate hours-long wait times after hundreds of TSA agents have now quit. At the same time, jet fuel prices have soared to 3-year highs here in the U.S. and to record levels in Europe, spurring United to cut 5% of its flights, those from less popular routes. CEO Scott Kirby saying the company is prepared for oil to hit $175 a barrel and to remain above $100 through next year. Let's bring in Oscar Munoz, the former chair and CEO of United Airlines. He's also a CNBC contributor. Oscar, welcome to you. Tough time to have to deal with both of these issues. Which one do you think is more difficult?
Well, I don't know that you can actually prioritize one versus the other because they all have significant impact not only on the business part of it, but also to customers and consumers.
I'm struck by the fact that airlines, they're up today. They were down a little as they navigate this, but we hear a lot of constructive commentary. Delta, American, they're still talking about, consumer demand is healthy. Their guidance was still pretty good. So why do you think they're able to handle something that is pretty disruptive and do so with, like they have planning contingencies like they're talking about, but they're able to kind of take this in stride?
Yeah, airlines don't really absorb fuel shocks in particular, right? We just reprice them over time. And we've had so much practice over the years. And you see the equities rising today on a minimal drop in oil. And that's how sensitive they are to this business. And so it's a constant aspect. I mean, I think the comfort that we all have, at least from my United sort of lens, is we're sort of always planning for these things and know how to get about it. And I think the real benefit that some of the big airlines have done since COVID is understand these big external shocks can come to you. So how do you get your balance sheet in a better place, right? How do you make sure that you keep growing and avoid the big, immediate knee-jerk reactions that we've had in the past? Much more resilient airlines. But of course, these shocks just keep coming, right?
Yeah,
and that's one after the other.
I look at shares of United, for instance, which were up, 26%, like they were up 40% basically. Then they sell off 15% into the year. And it's the old Buffett thing, right? Every time you turn around, there's something else to deal with. That said, what do you make of this idea to send DHS or ICE agents into airports to help with the TSA? Look, it seems like some creative solutions are needed. Travelers are certainly a little frustrated and stressed out. And the TSA agents probably feel like, ping pong balls. And they've got food banks going at some airports to try and support them. They're going to miss, go another month without pay at this point.
No, I think the general American public doesn't quite, sometimes, at least people that listen to this, all understand the level of wages that these folks have, right? One check is a very meaningful thing. Missing one or two, three, four, it gets increasingly, and it forces them to do other things. So again, that's the first and foremost understanding. This ICE thing, boy, it's politically, as everything else in our country has become, it's just fraught with all of that. Is it a creative solution, or is it just going to make things worse? I think we're about to see. I think what's important to know that this is a kind of an all hands on deck approach to keep the economy going would be the strategy of the administration. And these folks are not going to do the critical trained sort of screening aspect of TSA, but they're going to manage the perimeter. They're going to check credentials and see, again, be on the perimeter looking in, and that could be helpful.
Yeah.
I don't know what managing lines and flow is going to mean given their training with regards to what we've seen in past months. So, it's one that is in a lot of airports and is running an airline. People are in a hurry. They need to get to where they are, and it gets very sensitive. When the lines get that long, the level of tension goes up. And maybe this calms it, maybe this fuels it. But again, we need something creatively, because as in your previous segment, that it sounds like there was making some progress. I heard earlier this morning that there was conversations that were happening that might indeed be making some progress towards ending, sort of the government dysfunction that we have. But at the same time, that is not likely to happen that quickly. So this might be a creative solution, and we'll wait and see.
And to the kind of concerns people have, then you have the issue at LaGuardia this morning. And again, you want to make sure that all of these systems are operating smoothly and with the best resources, and not, and that there's. And maybe it's just our fear covering these issues in the media, and it's all fine in the grand scheme of things. But, it certainly contributes to a sense of concern. Oscar, thanks. I know we have to leave it there, but it's been great to have you. Come back anytime. Oscar Munoz. Don't miss United CEO Scott Kirby tomorrow, Squawk on the Street. That's at 10:10 a.m. Eastern Time to continue that conversation. And that's it for us. Thanks for watching The Exchange. Power Lunch picks up after the break. Stocks are higher on fresh hopes for de-escalation in the Middle East. Welcome to Power Lunch. Alongside Dom Chu, I'm Kelly Evans. We'll see Brian in just a moment. And here's where we stand at this hour. Dow's up about 841 points. The session highs, we were up 1,000. Still, we've been moving higher over the past hour or so. The S&P is up 1.5%. And look at the Russell's up nearly 3% after falling into correction territory at the end of last week. The other big mover is energy, of course. WTI and Brent both falling. Each are now down about 10%. Still, that puts Brent above $100 a barrel. But we had a WTI at 100 before the president spoke today about this 5-day pause in his strikes on Iran. Dom, over to you.
It's been a crazy day so far, not just for oil, but stocks overall, Kelly. Let's take a look at some of those sectors that are moving, sticking with that energy theme. That sector is hitting, by the way, a record intraday high. Names like SLB, Baker Hughes, Halliburton are leading that entire energy complex higher on the day. But the best performing sector right now is consumer discretionary, led higher by Norwegian Cruise Lines, Carvana, Carnival, MGM, and Royal Caribbean. You can kind of see that consumer spending tilt, maybe even fuel costs playing there. So, Kelly, keep an eye on some of these names. Solidly bid for right now. I'll send things back over to you.
All right, good point, Dom.